from the computation of this 5% exercise, the balance only should be considered. So money received through banking channel, money received in cash, both we have to take away. Balance cash receipts we will have to take, balance other than cash receipts we have to take, and see the percentage as a total, and then see whether this 5% threshold is met with or not. When this be the case, can we extend the same theory for a partnership firm or an AOP or a BOI? It's a question which would arise. Now, in case when a partnership firm receives money from partner, or AOP or BOI receiving money from its member, whether the same logic could be applicable. It's a question which may come up. For a proprietor, it is easy for us to say we have not received from anybody, it is our own money, or the person proprietor concerned had not paid to anybody, it is his own drawing. Quite possible. But in a case of a partnership firm or an AOP or BOI, in the eyes of income tax law, the firm and its partners are different taxable entities. Similarly, AOP and BOI and its member are different taxable entities. Therefore, applying the same analogy would be a bit difficult and it will lead to controversy. Although for partner and partnership firm in the eyes of general law may be one and the same, for tax purpose it may be regarded as independent two separate taxable entities. Therefore, receipt by a partner from firm or receipt from a partner by a firm would be regarded as an independent transaction, and therefore if that has to be considered at par with other receipts or other payments for reckoning this 5%. And it's interesting to note that the proviso placed is below class A. The 1 crore limit is sought to be increased to 10 crore for the purpose of applying the tax audit ceiling. Now, in class A it is placed. Similarly, in below class B, there is nothing so placed in the statute. Therefore, even if a partnership firm or a proprietor case where the profession is carried on and banking channel, the transactions are carried out through banking channel, the ceiling limit of 50 lakh will continue to apply for those professional cases. As because they are carrying out more than 95% of their transactions through banking channel, a professional case would not get an extended quantum for the purpose of being away from the tax audit. It will continue to be only 50 lakh. So that class exception is provided only below class A, and class B continues to remain at only 50 lakh, and therefore the case exception in class A will not apply for professional cases. Now, this exception provided in class A has to be read in conjunction with the provisions of section 44 AD subsection 4 and 5 and subsection 44 AB class E. All of us know section 44 AD subsection 1 provides for a presumptive concessional presumptive taxation. Subsection 4 says in case a person has availed subsection 1 first in any of the financial years from assessment year 17-18, and subsequently if he is unable to be in subsection 1, unable to offer that 8% or 6% as contemplated, then the year in which he works out plus 5 more years, he cannot get into this particular provision 44 AD subsection 1. And for the subsection 4 wherever applies, subsection 5 says the assessee has to maintain the books of account and get the books of account audited. Correspondingly, 44 AB class E refers to subsection 5 of section 44 AD. Now, let us say a person has in the financial year 2020-21 availed subsection 1 of section 44 AD. His turnover was 1.8 crore and his income, say 8%, both bank and cash transactions, 8% he has offered, availed 44 AD subsection 1. Now, in the financial year 21-22, assume for a moment that 2021 is the first year he has availed 44 AD subsection 1. And 21-22, the turnover has gone to 2.1 crore. Now, though in the earlier year he has availed subsection 1 of 44 AD, in the year under consideration, he has not opted out voluntarily. Section does not permit him to sit inside. Therefore, he is coming out of 44 AD because of turnover criteria. Now, 2.1 crore is his gross receipt. Now, between 1 crore to 10 crore, so long as he is able to meet the threshold of this 5%, the cash transaction is 5% or less on receipts as well as on payments, under 44AB class A read with proviso, he would not be required to get the accounts audited. So now turnover is 2.1 crore. 44AD subsection 1 last year he has opted. Current year is unable to be inside 44AD, therefore he is walking out, not voluntarily but compulsorily. Now 44AB class A first proviso says you have satisfied the conditions mentioned in the first proviso, therefore he is not required to get the accounts audited. Now let us slightly tweak the case. 1.9 crore turnover instead of 2.1 crore turnover. Last year 1.8 crore offered 8%. Current year 1.9 crore but could not offer 8 or 6%. Only 5% is the profit. He is unable to offer 8 or 6%. So therefore he is walking out. Now subsection 4 and subsection 5 of 44AD would apply to him. Now he walks out. Now according to that section, he has to get the accounts audited. Now in that case, in the 1.9 crore turnover of the current year, he is able to maintain that less than 5% or less cash transaction. 1.9 crore turnover between above 1 crore to 10 crore, but less 5% or less transactions in cash, both receipts and payment. But unfortunately, you would not be able to say, I have satisfied that 5% condition, and therefore I am not required to get the accounts audited, because he has been mandated to get the accounts audited by virtue of subsection 5 of section 44AD read with 44AB class E. So exception provided between 1 to 10 crore only for the cases falling under 44AB class A. When an audit is contemplated in 44AB class E, for that case, even if the turnover is between 1 to 10 crore, 1 to 2 crore, in those cases also, because the assay satisfies 5% or less cash transactions, he would not be able to be away from the audit. He has to necessarily get the accounts audited. So there are two differences where, because of turnover getting increased from above 2 crore walking out, and less than 2 crore but still satisfying 5%, the distinction between 44AB class A applicability. The SSC has availed the benefit of subsection 1 in a preceding year, of subsection 1 of 44AD in a preceding year, and in the current year, since the turnover has crossed beyond 2 crore and as a result is out of 44AD, and then in this turnover being in the given example 2.1 crore, he is able to maintain less 5% or less cash transaction on receipt as well as on payment side. He will be coming from 44AD, but he will come under 44AB class A. Proviso gives the benefit of not requiring to get the accounts audited because he is maintaining that 5% or less cash transaction. But if the turnover is well within 2 crore, but last year he is under subsection 1, current year he is not under subsection 1, he is unable to offer, as a result he is getting out. Subsection 5 would mandate him to get the accounts audited, and also subsection 44AB clause E would mandate him. For that, this exception would not apply. For if it is between 1 crore to 2 crore, he is able to still have a less than 5% cash transaction both the side. Nevertheless, he has to get the accounts audited because the exception provided is only for class A.
Right, sir. Sir, question here is, in the first year, what will be position?
Now, for a first year, he is not compelled to offer 8 or 6%. It is his choice. If he is offering 8 or 6% for the first year, next 5 year is compelled. Very first year, it is not necessary. If he is willing to offer, let him. If not, he can go with book results. Whatever results as per his books. To trace this, unfortunately, the law has become slightly complex. To trace this earlier 44AD, when 44AF got merged over there, it was only simple. Other than 44AE cases, law was simple to say offer 8%. If not, get the accounts audited year on year basis. Year in which you are offering 8%, no audit. Year in which you are not offering 8%, audit. That's all. The law was simple. But from assessment year 17-18 onwards, law underwent a change to say first you are offering, first you become eligible to come under, you are doing eligible business, eligible SSC carrying on eligible business, offering under 44AD subsection 1. An assessee who has availed the benefit of subsection 1, but in any subsequent 5 years time, he is unable to offer that 8 or 6%, then that year in next 5 years, he has to maintain books of account, get the accounts audited. So first year, if he is not coming under 44AD subsection 1, this block of 5 years restriction is not there for him. So very first year in which the firm comes into existence or a proprietor commencing the business, in those cases, first year, if the income is less than 8 or 6%, he can go with book results. Though the section 44AD subsection 1 start with a non-abstinent clause, by conjoint reading of subsection 1, subsection 4 and subsection 5 gives an impression that it is not mandatory to go under 44AD subsection 4 for all eligible businesses, and those who are not offering in the respective year itself, they have to get the accounts audited. It is not so. This scenario underwent a change from assessment year 17-18. More about it through examples we'll take up little later. Now, reading between clause A and clause E, proviso is placed only in clause A, not in clause E. Therefore, cases falling under clause E of 44AB, even though they maintain that 5% criteria, they are not exempt from carrying out audit when the turnover between 1 to 2 crore. They have to necessarily get the accounts audited.
Sir, here one question is there. One second.
Yeah, Mr. Ramnath.
Yes, sir.
Yeah, the issue is regarding the practically what happens. What I am given to understand that the very first year, if the turnover is between 1 crore and 2 crore, if you do not offer 6%, in that case, as per the law, you are not required to get the books of accounts audited. But the eligibility ask you, or rather they throw up a defective return, the CPC, saying that you have not got the accounts audited. Just if the members are attending, they can just throw some light on practically what is happening. Is my statement that I have made correct or not?
There is some echo in the voice, so fully I am unable to get, but let me just come back and say what I have listened is right or wrong. So between, we'll divide the issue into two. In the first year, turnover is, let us say, below 1 crore, one category. Turnover is above 1 crore, below 2 crore, category 2. We will divide them into two.
Okay.
We will approach this particular query.
Okay.
So if the turnover is between 0 to 1 crore, that is less than a crore or 1 crore or less, in those cases, in the year 17-18, the CPC had thrown open this defective return criteria because they have not tuned it for the year 17-18, assessment year 17-18 and 18-19, CPC had thrown open this error saying you have not conducted audit, but you have not offered 8 or 6%. Therefore, your return is defective. That issue came up in the first 2 years, but then the system got regularized. So after that, if in the very first year, a warning message will come while filing the return. Your turnover is less than 1 crore, but you are not offering 8 or 6%, you are doing eligible business. But in spite, if you continue to file, the system is accepting and the returns are processed, tax demands, refunds, calculations taken care of properly. But in the first year, if the turnover is above 1 crore but below 2 crore, and the assessee doesn't go under 44AD, then since the turnover is above 1 crore, now he has to examine until 2018, 19, and up to that, he is required to get the accounts audited for the year ended 18, year ended 19. But in the year ended 20, 1 to 2 crore, if he is less than 5% or less cash transaction, he will fall under class A, but proviso will escape him to get out of the audit requirement. So first year between 1 to 2 crore, if he is able to demonstrate 5% or less cash transactions, because of 44AB class A proviso, he is not required to get the accounts audited. But less than 1 crore, then audit under 44AB class A is not required, but warning message came. First 2 years CPC had this difficulty. Thereafter they realized and they corrected the system. So even if this is the first year, less than 1 crore case, we are not offering 8 or 6%. We file either loss return or less than that 3-4%. Return is getting accepted and refunds are processed. We had this difficulty in the earlier 2 years, sir. Thereafter it got regularized. Any other view on this also? Welcome.
1 second.
The proviso, the first, you are talking about the first proviso.
Yes, sir.
The first proviso reads like this. provided that this section shall not apply to the person who declares profits and gains for the previous year in accordance with the provisions of subsection 1 of 44 AD, and his total sales turnover, gross receipts, as the case may be, in business does not exceed 2 crore rupees in such previous year. And the example that you gave was where the turnover is between 1 crore and 2 crore. So here it talks about less than 2 crore, not between.
So that is the first proviso after class E. What you are referring to is the first proviso after class E. Are we in the same page, sir? I am in class A, first and second proviso. Sharmaji, I am audible. You are able to hear me?
Yes, sir. Yes, sir.
Okay. So I am now in class A, first and second proviso.
Yeah.
You are referring to after class E, the first proviso.
Right. So for further clarification purpose, if my turnover is 1.5 crore and I have offered net profit of 4%, however, my cash transactions are below 5%, whether I'm required to get my accounts audited or not. That is the question.
Fine. So now turnover is above 1 crore.
Yeah.
Offering between 1 to 2 crore, let us say 1.5 crore. We are offering 4% income.
Yes.
Cash transactions on receipt side and payment side falling below 5%.
Correct.
So above 1 crore, less than 2 crore, 44 AB class A, read with first and second proviso. It is not required to get the accounts audited. And we can offer 4% and file the return based on the book results.
Up to 10.
Yeah. Correct, you are. I appreciate.
Yeah, up to 10 crore rupees. That 1 crore gets substituted by 10 crores. We can go with book results.
Correct.
But in this case, we are not supposed to maintain the limit of 6 or 8%.
Not necessary.
Cash I am complying with, and profit is only 4%.
Yes.
So even percent restriction doesn't come in the picture.
Not necessary.
And even if my turnover is 80 lakhs, and I have never gone under 44 AD in the past.
Okay.
But last year my turnover was 2 crores, so I did voluntarily audit under 44 AB. But this year my turnover is only 80 lakhs. Then the restriction of 5% cash receipt payment as well as the restriction of 6 or 8% is not applicable.
Nothing is applicable, sir. Last year 2 crore audit done because for cash receipt about 5%. This year 80 lakh, therefore audit not warranted.
Okay, even if my cash receipts are more than 5%.
Yes, absolutely.
Or even if I show profit of less than 6%.
Not, yeah, even.
So audit is not at all required if turnover.
Not required, sir. Not required.
Okay.
So here now one catch is, so once you have got a 44 AD, and next year you are coming out, means you are declaring less than prescribed percentage, 6 or 8%. I think then audit for 5 years is necessary.
If you have opted for 44 AD, then next year if you try to come out of it, you have to do the audit.
Yeah, but that also he gave an example. If your turnover is 2.10 crores, then you are not. You cannot opt for that 44 AD.
Yes, then mandatory.
Then,
You are covered by clause A.
Correct.
Clause A, and the proviso also
If one
as
below 2 crores, then you have to.
None of the restrictions will apply, neither of 6-8% or 5% cash receipt and payments. Correct, Mahendra?
Right. Absolutely.
Yes, sir. You can proceed.
So once you enter 44 AD,
Then there is a problem.
Then there is a problem.
Yes, sir.
Continue, sir.
एक मिनट
And now, of course, the remaining classes, Class B dealing with profession gross receipt exceeding 50 lakh rupees, Class C dealing with 44 AE cases and certain non-resident cases, Class D where 44 ADA would apply, and income exceeding basic limit not able to offer 50%. Class E we have discussed where subsection 4 applies, then income exceeds basic amount, then the accounts are required to be audited and report has to be furnished by that day.
1 minute, sir. There is one question from participant. Mr. Naveen, bhai. Mr. Naveen. Hello. Hello.
Yeah. He's trying to speak, see.
Hello,
It's
Mr.
not
Naveen
audible.
Gandhi. Mr. Naveen Gandhi, you have to unmute yourself. Okay, proceed, sir. We will take it afterwards.
Okay, fine.
Yeah.
Naveen Gandhi, show of hands comes again.
Yeah, but somehow he's not audible.
Okay, fine.
Hello,
Yes,
Hello.
sir, please go ahead.
can you hear me?
Yeah,
Yes.
now I'm able to hear you.
Sir, sir, my question is, I was in 44 AD for the year 20, assessment year 21-22.
Okay,
This year, my turnover is 1 crore 80 lakhs. Okay, my income, my GP, my net profit is 5%. But I have received commission income, say of rupees 50,000 rupees.
okay,
My turnover, my 5%, that second proviso to 44 ABA, I am being covered, means I am eligible. So then, can I go with the book results without audit?
very interesting proposition, sir. Very interesting proposition. 44 AD, eligible SSE carrying on eligible business, the subsection 6 of 44 AD would go to say the section will not apply to an SSE having an income under 44 AA subsection 1, SSE carrying on agency business, SSE having income in the nature of commission or brokerage.
Right, sir.
There is a drafting problem. What intention may be different, but actual execution would be different. The section, though intended to say these type of income should not come under 44 AD, income in the nature of profession covered under 44 AA subsection 1, income in the nature of agency business, income from agency business, income in the nature of brokerage or commission. Those things should not have been, because when this 44 AD came in the law, some of the cases, even the professionals went under 44 AD, offered only 8%, even 30% slab 2.4%. They had a TDS of 10%, but 2.4% tax effect, balance they got refund. 1.5 years later, we had this retrospective amendment introducing this to say, but when they wanted to exclude these type of income, instead of saying eligible business does not include these things, the law got formulated to say, nothing mentioned in the foregoing provision shall apply in case of an assessee having profession covered under 44 AA subsection 1, assessee having brokerage or income in the nature of brokerage or commission. So the language of the law suggests that if the assessee in his total income has got agency income, or in his total income he has got a commission income, the section itself is not applicable to him. That means subsection 1, subsection 4, subsection 5, nothing is going to be applicable to him. If the actually the language of the law suggests that. So if that is the case, in the year in which he is walking out, let us say in the given example, last year I availed 44 AD subsection 1. In the current year, I am walking out because I am unable to offer 8 or 6%, but turnover is between 1 to 2 crore. I am unable to offer, therefore I am walking out. In the year in which I am walking out, let us say I've got 10,000 rupees or 50,000 rupees commission income. In that case, obviously, the subsection would go to say, nothing mentioned in subsection 1 or subsection 4 or 5 would apply to me. Therefore, as if there is no 44 AD in the statute book, I have to compute my income as far as my case is concerned. Therefore, audit is also not required. That is how the law suggests in the act. But if we say just 10,000 rupees or 50,000 rupees commission income available, that means for that assessee, even if he is not walking out, also 44 AD should not be applicable. Not only year of walking out, year in which he is willing to be inside, also the section should not be applicable to him. Because if the assessee has income in the form of brokerage or commission, the section is not applicable to him. If he is willing to avail also, he should not get the benefit. Let us take a case where a doctor has got, I've got this example later. Since we have got this query, I'm just giving this example. A doctor has a professional income. Also, he has got a small business income, though he is not permitted, but he is doing it and he is having business income. 44 AD says if he is a profession covered under 44 AA subsection 1, 44 AD is not applicable to him. Now the doctor files a return saying my professional income, on the professional income I'll offer 50%. I've got a pharmacy. For pharmacy sales, I'll offer 8% under 44 AD. The section is not allowing because you have professional income under 44 AA subsection 1 and under 44 ADA you are offering 50%, fine. In that case, 44 AD on a pharmacy sale should not be permitted. But the schema allows it. Now, in the year in which you are saying I have a profession, 44 ADA, gross receipt 50% I'm offering. Also, I've got pharmacy sales, gross receipt 80 lakh, I'm offering 8%. They are allowing it. Though the section says nothing mentioned in the foregoing provision shall apply in case of these people. Unfortunately, the schema doesn't prohibit, it permits. So in the same way, in the year of walking out, when we say we have a commission income or we have agency income or we have a profession income, we say section is not applicable. The schema will not read it that way. Schema will say you have not filed last year, you underwent under subsection and you were offering income. This year you are not offering subsection 1, but you are walking out, turnover is less, but you are not attaching audit report. The notice will come. We will have to fight it out going by the language of law. Because one side the schema says for a case under 44 AA subsection 1, still you can avail 44 AD. The system will not read as it is the way we interpret subsection 6 of section 44 AD. Therefore, it may result in litigation. But by going by the interpretation, it is possible, sir.
Then,
Thank you very much.
then what will be the position? He has to declare book results and no audit.
Audit compulsory.
No, sir. See, in that case, he will have to declare book results, no audit. But the system will say, the CPC will say it's a defective return, you have not given audit report, it has to be fought.
That's a good case to fight.
Yeah, sure, no doubt. That there is a language employed in 44 AD subsection 6 actually did not convey the real intention of the legislature. They wanted to exclude these three type of cases. But as because assessee has got these three type stream of income, the assessee itself is not eligible to come under 44 AD. That's how the language of the law today remains.
So he has to get his accounts audited, right? If he is not covered by the proviso. If he is covered by the proviso to subsection A, he does not have to get his accounts audited.
Yes.
No, sir. Now, if the turnover is between 1 to 2 crore,
yes,
and he is not offering 8 or 6%, but preceding year he has offered subsection 1.
Yes.
When he comes out, the provision compelling him to get the accounts audited because of walking out of 44 AD voluntarily.
Okay. But being a commission income, he is not walking out, but he is not eligible. My interpretation would be that he is not walking out. It's because of the laws, because the provision does not allow me to walk in.
Correct.
Now, in case we take the view that because of application of subsection 6 he is thrown out. He is not walking out voluntarily, he is thrown out.
Yes.
In that case, he is not coming under that subsection 4, read with subsection 5 of 44 AD, and class E of 44 AB would not apply to him. And as far as turnover is falling below 1 crore, no audit. 1 to 10 crore, so long as he satisfies first and second proviso, no audit required.
Yes.
So no audit. Yeah. Yes, proceed, sir.
Fine.
Yeah.
So now the third proviso to 44AB, third proviso says where a person is required by or under any other law to get his accounts audited, it will be sufficient compliance with the provisions of this section if the person gets the accounts audited under such law before the specified date and furnished by the date the report of that audit and further report by an accountant in the prescribed form, namely form number 3CD. So now, if the assessee is required to get the accounts audited under any other law, it will be sufficient compliance so long as he get the accounts audited under that law before the specified date. So that report itself is sufficient. In addition, he has to give form number 3CD. That's what the law says. Prescribed rule is 6G. Now 6G says where the accounts are required to be audited under any other law, audit report will be 3CA, and in a case where no audit is required under any other law, it will be 3CB. All of us know this particular proposition well. Okay. Now, interestingly, our institute last year came out with one institute article in the journal of the institute in May 2021, where the Taxation Audit Quality Review Board compiled or took the certain reports and compiled certain commonly noticed errors. This year, last month, the institute made that as a publication itself, a study on tax audit report, where they've identified many of the cases where the audit was required under any other law, but still our members have given form number 3CA and 3CD, no doubt about it. But still, in class 8 of form number 3CD, enabling clause under which we are carrying out audit, under that category, the SSC, the auditor has mentioned class A of 44AB. Now, our institute that study on TA or categorically says, when the audit is conducted under any other law, and we are relying on that audit report, and we issue form number 3CA read with form number 3CD, while filling up class 8 of form number 3CD, we should not quote class A, but we will have to quote third proviso to form number section 44AB. So class A, class B, class C, class D, class E of 44AB, and third proviso to section 44AB, which we will have to choose under which category we are carrying out audit. So there our institute has noticed that many of the cases where corporate associates, where balance sheet is matching or the financial period is matching, we have used 44AB class A. That is not appropriate. It is third proviso to section 44AB. So now a company, and that company is getting the accounts audited under any other, namely Companies Act. The financial year matches. In that case, the audit under income tax law is not required. The audit report under company law can be accepted as it is. So form 3CA has to be issued, and we have to give form 3CD. Class 8 of 3CD, we have to say third proviso to section 44AB. A company which has commenced, which has got incorporated on sometime in February. Now, company section 2 clause 41 of the Companies Act says if a company has got incorporated after January 1st, its first financial year will not be the immediate 31st March, it will be the next 31st March. In 1956 Companies Act, an option was provided for the company to close the first year shorter than 12 months for a company floated after October 1st. But other cases, either they can have a shorter period or they can have a longer than 12 months. The option was provided under 1956 Companies Act. But in 2013 Companies Act, the company has to necessarily take a longer period if the company got incorporated after 1st January. So if a company is incorporated on somewhere February or January, the immediate 31st March cannot be its first financial year. It has to be a longer period. If that's the case, let us say 1st April, suppose January to March 31st itself, its turnover is 200 crore. So January to March, it will not close according to Companies Act. So in that case, now that January 14th to March 31st, that first 2.5 months time, the turnover is more than 1 crore, but it is not able to maintain that 5% category. In that case, now it has to get the accounts audited, but under Companies Act, there is no audit. Now under income tax law, that 2.5 months accounts, we have to get it audited, and we have to issue form number 3CB. And for class A, we have to quote in section in class 8 of section form number 3CD. Now next year, April 1st to 31st March, 12 months time. In that next year time, turnover, let us say 11 crore. Now we have to get the accounts audited. But Companies Act from 14th of January to next year 31st March, 14.5 months, one audit. So now for that year also, again, for 12 months time, we have to do audit under Income Tax Act, issue form number 3CB. In that case, we have to again quote class A of 44AB, not third proviso to 44AB. The year 3, April 1st to 31st March. In that case, corporate audit report, income tax financial year, one and the same. In that case, we can adopt corporate audit report as it is. In that year, if audit is warranted, more than 10 crore turnover, now 3CA, 3CD. In class 8 of 3CD, we have to quote third proviso to 44AB. So now this is very important change. Of course, our institute study on tax audit report has made this point clear, because even otherwise our members were doing it. In some cases, it was missed out. Therefore, this attention is drawn. Similarly, in LLP, floated in the current year, anything after 30th September to 31st March, the LLP is having its option either to take that short year as the first financial year or the longest period, something more, that is 12. Suppose October 2nd or 3rd, it is floated from that day to next 31st March, it can take its first year. In which case, under LLP Act, for the broken period, less than 1 year period, there would not be audit. Then under Income Tax Act, audit has to be carried out. In that scenario, 3CB, 3CD. So it's not necessary that for a company or an LLP, always it should be 3CA, 3CD. In cases where the financial year does not match under the relevant act and under Income Tax Act, even for those entities, for the financial year under Income Tax Act, we will have to have the audit under Income Tax Act, and we have to issue form number 3CB, 3CD. And in those cases, class A will come. But otherwise, where financial year matches, then we'll have to say 3CA, 3CD. We'll have to choose. And in class 8 of form 3CD, we have to say third proviso to form number 44AB is what we'll have to choose. And in case where cooperative society is also where audit is order, we'll have to take the same provision. Audit under GST Act, our institute, that study report says it is not an audit to express an opinion on financial statement. It is only to verify the correctness of the information given in the periodical reports filed with the department, and therefore it is not amounting to audit expressing opinion on financial statement. That cannot be accepted. Therefore, under income tax law, audit has to be carried out. Now, one more practical aspect. Some cases where our TAQRB noted that the first page of P&L account, first page of balance sheet as per the audit under other law is added. But our institute, that study says not only the one page P&L, one page balance sheet, all the notes, financial notes, disclosures, everything should be made part and parcel when we are uploading the financials in PDF. It is not the face of P&L, face of balance sheet, all must have to be uploaded, is what the recommendation of TAQRB, because the section, the form itself says all documents part of and annexed to the financial statement are appended, is what form 3CA says. Therefore, we are required to give the entire bunch, not the face of P&L, face of that first one page P&L, one page balance sheet. Is not appropriate for a company PDF. We have to oppose. Now, quickly on our institute guidance note clarifying certain aspects. Quickly, let us run through this. One is a case where the turnover of the assessee is 98.5 lakh, and it has given 3.5 lakh rupees. It has received during the year by sale of car, which has been shown in the GST return as proceeds. Now, for the purpose of applicability, do we need to say this has to be factored or this should be excluded? Where our institute guidance note makes it clear that his total sales turnover gross receipt in business should exceed 1 crore of rupees. Here, selling car is not his business receipt. Therefore, this has to be excluded. Balance is falling below 1 crore. Therefore, the audit is not required in this case. There's another one view from our guidance note we pick up. It's a case where the assessee has made a turnover of 101 lakh. It has a sales return of 2.5 lakh. We further examine the sales return. We are able to identify that out of 2.5 lakh, 2.25 lakh return out of the preceding year sale, and current year return is only 0.25 lakh. Now, when you are setting off this 2.5 lakh against 101 lakh, If you set off the entire return of the current year against the sales, the net sale is only 98.5 lakh, which is falling below 100 lakh. Therefore, audit may not be required. But if you further bifurcate this return of the current year out of the current year sales, that means only 0.25 lakh. If we remove that alone from 101 lakh, we will get only 100.75 lakh. So the question arises whether the return of the current year, irrespective of the sales made in which year, whether that has to be set off, or return in the current year out of the sale of the current year, that alone has to be set off for the purpose of reckoning the turnover, wherein our institute guidance note makes it clear that return of current year has to be set off or reduced from the gross turnover, irrespective of the year in which the original sale took place. Original sales need not have been taking place in the current year. It could have taken place in the preceding year, but return has taken place in the current year. That is sufficient. That has to be netted off. So therefore, the return of current year has to be netted off against the gross sales to ascertain the applicability, irrespective of the year in which the original sale had taken place.
So here it's a view to second view is accepted by the institute.
No. First view. First view.
First view is okay.
First view is accepted. The institute says ignore the year in which the sale had taken place. The current year entire return sets against the current year gross sales.
I appreciate. But what is your view?
First view, sir. I am also agreeing with it. Because if we canvass the second view, that return will never get addressed anyway.
I appreciate. I agree with you.
Yeah. Now, this is a scenario where a practitioner, this is the example I was trying to correlate, but anyway, since the other query had come, we have almost taken a part of this discussion already. A medical practitioner having a clinic and pharmacy, professional gross receipt is 40 lakh and his pharmacy sales 70 lakh. Now, we independently see this professional gross receipt is less than 50 lakh. Therefore, class B will not apply to this assessee. Because in order to have 44AB class B, his professional gross receipt should exceed 50 lakh. Therefore, it will not apply. Coming to pharmacy sales, assessee having business and turnover gross receipt total sales in business does not exceed 1 crore rupees. Therefore, for pharmacy sales also, there is no applicability of 44AB. And in that case, obviously, there will not be an audit required under 44AB for this assessee at all. Nothing to worry. But now if 40 lakh rupees is not able to offer 50% of this 40 lakh, he is saying his actual net income from this 40 lakh is only 15 lakh, then 44ADA will apply. And he is not able to offer 50% and therefore 44AB class D will apply with reference to this case. So now that's one scenario. Now we'll slightly tweak this number. Now he is able to offer 50% of this and he is willing to offer 10%, say 10% of this medical shop. Now 44ADA he will choose for professional income. He will offer 50% comfortably, he will sell to. Coming to medical shop, pharmacy sales, he says his margin is 10%. So 70 lakh into 10% he is offering. And though 44AD subsection 6, as we discussed, an assessee having income in the form of 44AA subsection 1, 44AD should not apply to him. The schema permits that he can avail 44AD subsection 1 with reference to this case. Schema permits, but technically the section should not permit because section should not apply to him. Schema permits. Now, he is willing to offer 50% of this and he is willing to go by book results for this 70 lakhs. This is the first year, let us say. He has not gone under 44 AD in the past. In which scenario, for 40 lakhs, he will go under 44 ADA. For this, he will go under book results. Nothing prohibits, no problem. Now, he has got 40 lakhs and here, instead of 70 lakhs, it becomes 110 lakhs. And he is unable to maintain the threshold of 5% cash because pharmacy sales, therefore cash transactions are more. In which case, now for this 110 lakhs, Under clause A, he would be required to get the accounts audited. Now, this is below 50 lakh, professional gross receipts. Whether this is required to be audited. Pharmacy sales 110 lakhs, unable to maintain the threshold of less than 5% or less cash receipt. Therefore, he is exposed to audit under 44 AB clause A on pharmacy transactions. Now, coming to profession, it is falling less than 50 lakhs. So, can we say this is not applicable? One view is that it is not applicable. But our institute guidance note says, once his business income becomes liable for audit, his professional gross receipts, irrespective of the quantum, he should also be liable for audit. I personally unable to subscribe to that view, but however, our institute guidance note says, if this becomes 110 lakh, this is 40 lakh, you have to get this account also audited. What the institute's pronouncement as on the applicability of tax audit. Now, if interestingly, if 110 lakh rupees, this assessee has got less than 5%, he is using GPay, etc., on less than 5%, then he will not be required to get the accounts audited for his pharmacy sales. And so long as he is able to offer 50% under 44 ADA, no problem. Otherwise, for this 44 ADA violation for profession, audit would be warranted.
This you are going on the presumption that both the both the businesses are maintaining separate books of accounts. For all practical purpose, that doctor will be maintaining only same set of books of accounts. How can he bifurcate 50%, or does he have an option to allocate certain expenses towards the sale of medical shop?
Medical shop anyway, purchases would be there now. Pharmacy sales, pharmacy purchases would be there.
But still, since it is 10% in your example, you said, so 4% takka he has an option to offer, no?
Yeah. So now, see, anyway, and the very first line to say, this presumptive provisions would not give the assessee a guarantee that if his income is more than that, he can go offer this much and get away. If his actual income is more, he is compelled to offer that much. Supposing his actual income, his profession is only 50% and his profession medical shop sale profit is only 10%, he can go with that. Suppose his medical shop margin is 20%. He is duty bound to offer that. He will not be given a clean sheet if he offers 8%. Nevertheless, he has got another 12% added to his capital account as a source. That is not permissible.
Yeah, that's not the issue that we are discussing. All right. Okay. Yeah. So
if his cash flow says he has got only this much income, the after meeting expenses, drawing withdrawals, etc., if his cash flow says his investment during the year or the incremental assets base says only 50% of his professional income and 10% of pharmacy sale is only left over, then to that extent we are able to match cash flow, etc., then we can say this is the income. Probably professional income would have been slightly more, pharmacy sales would have been less, or vice versa, but still we can go with this because Eleki Shetter, Karnataka, that is Bangalore Tribunal, and Yepan's case, our Cochin Tribunal says if a cash flow matches, that balance 92% in the business or 50% in profession, the department cannot demand for the actual spending. That is not possible. So as long as cash flow matches, fine. If the cash flow supports and there is no incremental, other than this, there is no incremental investment, we can go with this presumptive provision.
All right. Yeah.
The danger would come when the actual cash flow suggests something more is there. In which case only trouble will come. In that case, the difference has to be factored, and the difference is well within the reasonable number. At least later on, ASI can defend to say it's income from profession. If the number is going to be very high, department may say that's not even from profession, it is from undisclosed source. In which case, the rate of tax will not be normal, it will be special. 115 BBE make it triggered.
Right. Sorry.
Then comes a case where it's an assessee. This assessee all along carried out an audit. For the number's sake, the income is only 5% of its turnover. The current year, what to do with this particular assessee's case? In this principle we have discussed already. Assessment year 17-18 onwards, the law underwent a change. And therefore, prior to 17-18, if the income is less than 8%, audit is mandatory. But this assessee, even though law underwent a change, continued that practice, less than 100 lakh turnover, less than 8% profit, therefore voluntarily underwent an audit. He continued to carry on the audit. But in the all last 5 years, not even 1 year he has availed 44 AD subsection 1. Since in the preceding 5 years, not even once he has availed 44 AD subsection 1, current year the turnover is less than 100 lakhs. He is not required to get the accounts audited. Not by invoking 44 AB clause A, also clause E, because clause A will not apply because turnover is less than 100 lakh. Clause E will not apply because in the preceding year never he has availed 44 AD subsection 1. Therefore, for him this year there is no audit required. Also, he is not compelled to offer 8 or 6%. He can go with book results.
And he is not even restricted by the 5% cash receipt or payments.
It is less than 100 lakh, and therefore that problem also is not there.
Okay. So we carried out audit.
No, there is no
audit for this case.
Because he has never opted for 44 AD in the past.
But it was less than 6%. So why he has not opted?
Sharmaji, from the beginning, his income was less than 8 or 6%.
Okay.
But ignorantly he was conducting audit. He was getting the accounts audited. The audit was there from assessment year 17-18 only when the preceding year he has availed subsection 1 of 44 AD.
Okay.
He has not availed at all. Therefore, even in the earlier 5 years also he could have gone with book results.
Okay.
But he inadvertently got his accounts audited for all the 5 years.
Okay.
But now coming to current year turnover is less than 100 lakh, therefore class A will not apply. There is no need for audit.
Yes.
Preceding year never he availed subsection 1 of 44 AD. There is no question of walking out. Therefore, class E also will not apply. Therefore, in both accounts, he is not required to get his accounts audited. He can go with book results, offer the actual income as per his books.
Okay, got it.
These are certain initial discussion on our applicability of tax audit. Now we'll come to certain classes. More number of issues are cropping up with the comments in our guidance note, but I will select a few which will have some practical applicability to the extent of time available. We'll try to take up certain matters and take up for our discussion as well. We'll know Form 3CD is an annexure to Form 3CA, 3CB, because 3CA, 3CB audit report, it talks about expressing an opinion on the financial statement. But 3CD is an annexure giving statement of particulars, giving certain details about whatever asked for. So the primary responsibility to provide accurate data in Form 3CD is on the assessee. Our responsibility is only to verify whether the data so furnished is correct or not. This is what is expected of. But in real life scenario, we will help the assessee to compile the information properly in Form number 3CD. But though in real life we help, we will have to keep this particular principle in our mind. There should be a Leishman record drawn. Assessee's responsibility is to prepare and give Form number 3CD, and our responsibility is to express an opinion on the same. So, for the purpose of documentation, when we are obtaining management representation letter, one copy of Form 3CD duly signed by management has to be taken on record and kept. So that later on, if any discrepancy found in the audit report furnished, etc., at least we can say this is what they have compiled and given. We have done all the test checks as contemplated by our institute. We have got these working papers, we verified, and even if some small errors took place, at least this would help us to get out of it. So therefore, it is necessary for us to obtain an MRL. Along with that, one copy of Form number 3CD duly signed by management should be taken on record so that it will be helpful for us later on. First. Second, Form number 3CA, 3CB expresses opinion on the financial statement appended. But Form number 3CD contains information on certain questions. The factual accuracy has to be established, because we say, in our opinion and to the best of our information according to the examination of books of account and including other relevant documents and explanation given to us, the particular given in the said Form number 3CD are true and correct. As far as expression of opinion on financial statement, we say it is true and fair. So materiality concept would apply there. Coming to the information furnished in form number 3CD, we say the particulars given are true and correct. Therefore, we have to establish that the factual accuracy is not compromised. But in real life, there will be magnitude of information. Therefore, our institute guidance note gives in certain cases, we can do test checking. We will not be able to 100% verify the factual accuracy of all the information furnished by assessee in form number 3CD. So our institute gives us the comfort that we can do test checking in certain cases, but we'll have to document that in which of the cases, in which particular population of sample we have test checked and what were the outcome, how we have documented it. So in every quarter, some point, some 15 days, some 10 days, we have taken for certain particular classes, cross-checked, and we are satisfied with the outcome. Therefore, we believe for the rest of the period also, the same trend continued. That documentation is to be kept on record so as to establish that we did test checking for some population of the period so that the rest be representative in nature. That we have to take care.
Now,
Yes, sir.
Now we have this digital signature. We have to pay from the management before uploading the 3CD.
Yes, sir. Before, after uploading, we say
confirming the information in 3CD. So over and above that, should we take a physical 3CD also to be signed by the management?
Yes, that is before our signing of 3CD, before we carry out 3CD. What our guidance note says is, before we carry out audit, assessee requests us. Assessee says, he gives some representation in an MRL and he says, this is the form 3CD, please carry out audit. So he requests us. So he gives this and asks us to carry out audit. So we take his form 3CD, check with books, other documents and find whether the information is correct or wrong. Then we upload from our side. Okay. So therefore, first assessee's request should come. Their MRL coupled with one copy of 3CD signed by management is necessary.
Okay.
Now, certain cases, our view on the information furnished in form number 3CD and the information given by assessee may not match. Sometimes assessee may say, I would like to give like this. And we will say, by interpretation of law, we would like that to be given in this form. Sometimes it may not match. In that case, earlier, we did not have the option. Either we should compel the assessee to correct or we'll have to, there is no space specifically to say what to do. But now, para 3 of 3CA and para 5 of 3CB provides for a space to say in any of the 44 clauses which we have with some alphanumeric clauses added to that, we have any comments where assessee says this is the information I would like to give and we are unable to subscribe to that view. We would like to defer. We are unable to convince or we are not willing or he is not willing to change and therefore we would like to defer from him. In this case, when there is a difference of opinion, para 3 of 3CA or para 5 of 3CB, we have to draw the attention of the difference between our version and SC's version, but still assessee's version can go, but we'll have to draw attention, very clear. But if the number itself, there is a variation, then there would be some issues. Let us say, for example, one example where an assessee borrowed money from Mr. X and that Mr. X passed away in the middle of the financial year. X's son comes and says, my father gave you 10 lakh rupees. This is the will in which he has mentioned this entire 10 lakh will come to me. My other family members agree. Therefore, now onwards, it is the loan given by me. So for this reason, the assessee transfers by journal entry the loan from Mr. A to A's son, 10 lakh rupees. This closure of A's loan, borrowing of loan from A's son, not through account pay instrument. So technically, this is in violation of 216 SS and T. Technically, it is in violation of section 216 ST, SS and T. Courts have said this would not lead to levy of penalty. But technically, it is amounting to violation of section 216 SS and T. Do we require to report this in form number 3CD clause 31A, 31B? Assessee may say, if we report it, we will have to prove all these things, notices for penalty may come, thereafter issue would come. Therefore, I will not report this, because in class 31 says name, permanent account number, the amount borrowed, peak amount, and whether squared up or not, mode, account pay cross to check, account pay cross to draft, ECS, others. If you put others, it may pick up for verification, then I will have to undergo order. Therefore, there is no clause for journal entry. Since there is no clause, I will not say others, but I will say account pay. So that system will recognize as well in accordance with law. But it is not account pay. So therefore, if it is a non-corporate assessee, we are issuing 3CB for this case. In para 5 of form number 3CB, we will have to say in class 31, assessee has mentioned as far as this particular borrowing and this particular repayment as account pay, although it is by journal entry. That reference we will have to give. If the numbers what we give in audit report and in 3CD and what the assessee files in return of income varies, 143 subsection 1 class A subclass 4, a proposal will come for adding it or disallowing, etc. But if the number is correct, but only disclaimer comes in form number 3CB or 3CA, it may not trigger 143.1, but other issues may come which assessee has to face later on. But at least to this extent, as professionals, we will have to safeguard our interest by making a proper disclosure.
Sir, one small clarification I want, sir.
Yeah.
See, you said that 3CD signed copy from the assessee should be taken on the record. See, I'll give a concrete example. I'm signing the audit has been completed. 3CD is ready today. That is the 23rd of August. So 23rd of August, normally we keep the date of balance sheet as signed by him. 24th, the auditor signed. 3CD also normally we put the date 24th of August. Now this from this copy of form 3CD duly signed by the assessee as well as the MRL. Sir, what date we should take for that?
Any day prior to the date of signing, sir.
Any day. That I accept, but then normally it should be some 20-15 days before.
Not necessary, sir. Parallelly, he can keep giving it. Parallelly, he can give and we can do audit and final numbers are coming with a request. That doesn't mean after he give only we start audit.
Actually, that is my worry.
No, not necessary, sir. Sir, we have a very live tribunal judgment. This is dated, so it is not that after that only audit gets commenced. So
okay.
Any day, at least one day prior to that would be sufficient, sir.
Okay. Sir, that tribunal reference is there?
Right now, not there, sir. We will discuss. I will send it across, sir. Not a problem.
Okay. Very kind of you, sir. Sorry, I'm keeping you troubling. No problem.
No problem. We can. My email is available in the presentation. You can post it. I will send it across. Not a problem.
Thanks.
Now, the next change is class 8. We have already discussed in detail whether class A would come or class B will come, class C should come, or class D or class E or third proviso to 44 AB, which we have to choose. Wherever we are issuing form number 3CA, 3CD, financial year also matches, audit under that law, and financial year matches, we have to choose third proviso to 44 AB. Under income tax law, audit is contemplated. A, B, C, D, E of 44 AB, we have to choose. That is what we will have to indicate in class 8. Class 8A insertion came to say, if the assessee has opted for taxation under concessional rate, or 115 BA or BAA, BAB, BAC or BAD. These classes came, but now what actually happens is, we are asked to comment on something. The assessee would do something after our report, but before filing return, and he will file return later. There is an interregnum time between our filing of the tax audit report and his filing of return. These are all actions where he would do after our audit is over or after filing of the tax audit report, but we are asked to comment about what his plan is. If the case is such that in the preceding year itself he has opted and he continues, then it is easy for us to say he has opted the special regime. But if this is the first year of the assessee, Now, how will we say whether the assessee has opted for taxation? Very difficult. He will have some more time to decide and opt for it. Now, before our issuing of the audit report, he has opted, he has filed the required form, 10IE, etc. Then the acknowledgement available will be helping us to say, yes, he has opted. But he has not done so, and he has concrete that he is not going to do, we can say, no, he has not opted. But on that day, there is no filing of form. Therefore, we say no. Later on, if the assessee opts for it, there will be an inconsistency. So our audit report says he has not opted. Later on, after filing of audit report, before filing the return, he has made up his mind to opt for it, then the issue would crop up. So our institute guidance note says, if it is a first year, get this particular point clarified by the assessee in the MRL, whether he is willing to offer or go under this concessional treatment. Then based on this declaration, you say whether he is willing to opt or not. So this particular clause theoretically will pose certain difficulty, practically it will pose some difficulty. Theoretically, it may be easy to say so. After our filing tax audit report and accepted by assessee, later on assessee has changed his stand. 143(1)(a) clause 4 would say there is an inconsistency. Some sort of nuisance value will get triggered. Therefore, before furnishing our audit report, assessee has to make up his mind, and then accordingly we should say, so that the future difficulty in handling the CPC notices could be avoided. Coming to professionals, class 11, dealing with books prescribed, maintained, examined. 11A, BC. Prescribed. Books prescribed only for 11 specified professionals. 7 mentioned in the statute and 4 notified subsequently as per Rule 6A. For all other professionals, other than this 11 professional, for all other professionals and all businesses, books not prescribed. In other words, 44AA subsection 1 says 11 professional. 44AA subsection 2, all other professional and all business. For 44AA subsection 2, books not prescribed. 44AA subsection 1, books prescribed as per Rule 6A. So now, when we are carrying out audit of 44AA subsection 1, 11 category people, we'll have to say book prescribed, yes. All other professionals and all business cases, we will have to say book not prescribed. There are some cases, our TAQRB report says, even for business cases, it was mentioned as books prescribed. That type of error should not happen. Then books maintained. So that's prescribed or not prescribed. Whatever maintained, it has to be mentioned. Now, when books are maintained at more than one place, then all such places we have to report. Plus, in which place, which type of books maintained. Place and the books. More than one place, whichever place, whatever books maintained. That we have to report appropriately. More than one place, such places as well as books. We may need to draw the attention of section 133A in this particular proposition. Section 133A enables the income tax authority to carry out survey. In case where he carries on business, that particular premises of the business can be subjected to survey during the business hours. The entry can be only during business hours. But where the books, documents, assets maintained, kept in a place other than the business premises, the survey authorities are entitled to enter into such premises after the sunrise, before the sunset. And very interesting, the law only talks about the timing of entry. Law does not worry about the timing of exit. So now, if our tax audit report says this is the business place and these are the books maintained. This is godown, this is where stock register maintained. This is administrative office, this is where other records maintained. So now business premises, the survey authority has got a right to enter into the premises during business hours. Let us say, for example, there is a hotel which starts evening 6 o'clock, goes up to 12 o'clock. The entry can be only after 6 and before 12. They cannot go in the morning. But if the same hotel case where the books are maintained in a registered office or books are maintained in a different place, administrative office, that can be subjected to survey after sunrise, before sunset. So therefore, in this clause, whatever place we are referring to and the books where it is maintained, In a case where the assessee would be subjected to survey, this information would be helpful, and therefore, before filling up the information under clause 11b, the fact has to be culled out properly and it has to be appropriately disclosed. Now comes books of account examined. So assessee maintains books of account from which we are examining the books of account. So what are books he has maintained, he claims. Out of that, what all we have examined, we are saying these are the books we have examined. On manual days, our institute guidance note says we have to place mark of identification that we have examined. Today it is in a computerized environment and therefore placing of mark of identification is not possible. So we'll have to have adequate electronic documentation to say that we have reviewed either reports, backups, etc. to see that we have examined it. Now, in addition to books, we are required to also say what are the other relevant documents examined by us. So books examined by us, also documents examined by us. So when book contain an entry, to support that entry, whatever document relied on, that's a primary document, all primary document we have to say. Sometimes we will be very cross-verifying this with secondary documents. We can include the secondary documents as well. But secondary documents, there is no end to the list. One can continue to say on and on. But all primary we have to say. Let us say, for example, there is an entry for sale. So sales invoice primary. But of course, to cross-verify, we can go for GST return, party confirmation letter, etc. They are all corroborative evidences. We can add those lists. But still, primary documents we have to give, and all secondary, by applying professional judgment, we can list a limit to the secondary documents and fill it up. So not only books examined by us, also other relevant documents examined by us, we have to report here. I think there is one request, showing of hands. We'll take that question.
Okay.
Yes, sir, please.
Yeah, one second. Okay.
He is lowered his hand, no, it's again,
Lowered his hand. Yeah.
first one.
He has lowered his hand, sir. Please proceed.
Okay, fine, sir. Now, these are the 11 professionals. These are as per the statute. These are the additional prescribed professional. For these cases, we will have to say books prescribed. For all other cases of profession and all businesses, we say books not prescribed. And interestingly, the code for 44 AD, 44 ADAE for professional, interestingly, these are all considered as profession. And these are all considered as business, fairly so. Interestingly, it says, but let us say super specialty hospital and specialty hospital, nursing homes are classified as profession. But in real life scenario, nursing homes pushes super specialty and specialty hospitals should be regarded as business. Nursing homes, we have a direct judgment to say it will be regarded not as a profession but as a business. Our institute guidance note also says so. But for the code, the income tax department created, nursing home is classified under 44 ADA, not under 44 AD. Is something we should take note of. And all these cases considered as practices for medical. And coming to profession, accounting, bookkeeping, 44 ADA, tax consultancy coming under consultancy. Fashion designing, photography is also considered as profession. But within this 11 profession, we are unable to say where it will come under. Because only 11 profession can come under 44 ADA. All other profession cannot come under 44 AD, but it can go with book results. So 44 AA subsection 1, 44 ADA. All businesses other than ineligible business can come under 44 AD. So all other profession can go with book results. But this photography is not coming under 44 AL subsection 1, but still 44 ADA permits it. Similarly, culture and sport categories, literary, all that 44 ADA permits, but it is not in sync with 44 AA subsection, but the code permits, and if the SSE files are written, the return may get processed. And in relation to information technology, Certain cases, the code says they are all profession, but certain other cases, they are considered to be not profession, but eligible to come under particular AD. This may also be taken note of whenever the returns are getting filed. Now, coming to few other select clauses for our discussion. 43B clause 26 deals with 43B, and notwithstanding anything contained in any other provisions of this Act, a deduction otherwise allowable shall be allowed irrespective of the method of accounting followed by RRC only in the year in which it is actually paid, is what the preamble. And it talks about tax chest duty, labor welfare contribution, bonus, interest on term loan and working capital loan from a scheduled bank or public financial institution, leave encashment, rent for use of railway properties. But interestingly, after class T before class E, we had this insertion. Any sum payable by RRC as interest on loan or borrowing from a deposit taking NBFC are systematically important non-deposit taking NBFC. This is not figured out in form number 3CB class 26. It only talks about class A, B, C, D, E, F, G. This DA of 43B is not incorporated in the form. Though section says 43B is applicable on the interest due to NBFCs, deposit taking or non-deposit taking NBFC. According to 43B, this interest is to be allowed only if it is paid before the end of the financial year or before the due date of furnishing return in the year of its accrual. Section applies, but from audit report perspective, there is no provision, there is no requirement to disclose this in class 26 because class 26 is A, B, C, D, E, F, G of section 43B, not class DA. This is what our institute guidance note draws attention. Now, in the year in which it gets accrued, before the end of the financial year, it is paid, fine. At least before the due date of furnishing return, it is paid, fine. That is missed out, then in the year in which it is subsequently actually paid, in that year, it will qualify for deduction. Now, when the dates between filing of tax audit report and filing of return are one and the same, this was not posing much of difficulty. But now we have that 1 month gap before filing of return and before filing of return and tax audit report. Classic example would be current year. Bonus. Normally bonus is paid somewhere nearer to Diwali. This year, assuming due date is not getting extended, 30th September, we need to furnish audit report. 31st October, return is required to be filed. Now, 24th October, Diwali. Suppose somewhere after 10th to 17th, bonuses are paid. On 30th September, when we are uploading the tax audit report, we will say bonus not paid. But before filing return, before 31st October, assessee would say, I have paid, therefore I will claim it. And 143, subsection 1, class A, subclass 4. Auditor says in his report, this much bonus inadmissible. But in your return of income filed, only this much is shown as inadmissible under 43B. Why should we not make up addition? A proposal will come, granting 30 days time. When I was co-opted as the Direct Tax Committee member year before last year, I said we will recommend that in the return, let there be 3 columns. Outstanding amount on 31st of March, paid before the issuance of audit report, before the due date of furnishing return. Let there be 3. Before the issuance of audit report, whatever number we say, let the system verify that with the audit report. So long as they are matching, they will be disallowable. Anything paid after the audit report, but before furnishing return, the assessee voluntarily says, number is reasonable, let the system take it up. Otherwise, let them cross verify based on the risk management strategy of the income tax department. That could be always checked. That was what the suggestion we had given. Otherwise, it will be amounting to duplication of efforts. Instead of accepting this suggestion, the Rule 60 itself got amended to say tax audit report can be revised. After we file tax audit report, before furnishing return of income, the assessee has made certain payments. As a result of that, he would like to increase his claim. In order to sync the audit report with the return of income, the auditor can revise the tax audit report so that the amount given in the revised tax audit report and the return of income will speak each other well in the same tone, and CPC will accept it. So for 43B and 40A1A, 40A1A, wherever before the data furnishing return, there is a variation compared to the audit report what we have already given. We are entitled to, at the request of the SSC, we are entitled to give another report. So that means what happens technically, we are recalling the earlier report, cancel the DIN, take another UDIN and issue next report, that too before furnishing of return by the SSC, and we will furnish the return of the SSC, then SSC furnishes the return, then the number will match each other. This is what the way the income tax department has identified in order to see that notice doesn't come from CPC. But instead of making the return form simpler, we are asked to once again do the uploading exercise in order to see that machine reads properly. In real life scenario, it will be an added work to the councils without having any extra remuneration is what one can talk about it. Advance those days excess duty and today GST, whether allowable, is a very interesting question. Originally, this has paved way for introduction of section 145A, and thereafter also this controversy continued. 43B says, notwithstanding anything contained in any other provisions of that, a reduction otherwise allowable shall be allowed irrespective of the method of accounting followed by RC, only in the year in which it is actually paid. So 43B was considered to be a provision beneficial to the revenue. Some assessors took it for their benefit and say, I have paid on 31st March over and above whatever is due to be paid, few more lakhs of rupees. Going by 43B language, I would say the deduction otherwise allowable will be allowed only in the year of actual payment. I have paid before 31st March, sitting in the balance sheet as advance GST paid in advance. I'll claim that also. This is the scenario where, so long as it's a physical payment, not an ITC credit, but a physical payment lying in the cash account, this can be claimed as reduction, but it's only a postponement of tax liability. Instead of paying to current year, we are postponing 1 year and it'll have a chain reaction. Next year also that much amount it should be there. Otherwise, this will get postponed to next year's taxable income. That assessee should be ready with. At least he can take 1 year time to keep postponing the tax incidence. But it will not be a permanent solution, but it will be a postponing tax incidence. And interestingly, the departmental argument is a reduction otherwise allowable only can be coming under 43B. This is an advance excise duty paid or advance GST paid. Therefore, it is not a deduction otherwise allowable. Therefore, it should not come as a reduction for this year. But the Honorable P&H Special Bench Tribunal said a reduction otherwise allowable given in the legislature need not necessarily deduction otherwise allowable in the current year. So long as it's a permissible reduction, not necessarily in the current year, it will qualify for reduction. Law does not say a reduction otherwise allowable in the current year should be allowed only in the year in which it is actually paid. That is not the language. Therefore, either excise duty or GST is otherwise allowable deduction. Therefore, if even it is paid before 31st March as an advance, it should qualify for deduction.
Which is the special bench?
Yes, sir. It's a larger 5-member bench, I believe.
But some High Court or Supreme Court judgment was also there.
Supreme Court judgment.
Yeah, but that is, there are two things, sir. One is on a cash payment made in that account will qualify, but if the amount paid is ITC sitting in the asset side, that will not qualify.
Okay. Yes.
No, we are saying that for excise there is a Supreme Court judgment also. I think.
Same line of thinking, sir. Same line of thinking that the otherwise allowable, I take that lead from that judgment. Otherwise allowable need not be current year otherwise allowable. That ratio has come from the tribunal judgment.
Taking the recent notification and circulars, notification number 37 of dated 21st April 2020, CBDT has given additional condition stating that there is compulsory filing of return. The situations are receipts and turnover of business exceeds 60 lakh, receipts of professional exceeds 10 lakh, TDS and TCS exceeds during the year is 25,000 and 50,000 for a resident having more than age of 60 years. Or the saving account balance of the resident has to be 50 lakh or more. The cost inflation index of financial year 22-23, or that is assessment year 23-24 is 331 for the calculation of capital gain under section 48 of explanation fund. Notification 3703 dated 5th August 22 exercise the power conferred under the section 17(2) clause 2C that goes to a person who is convicted with COVID-19. The employee has to give details of all the documents, the COVID report and medical reports to the employer. And also he has to give a certification for all the expenses which he has incurred during the course of treatment to his employer. So in case the amount is received from the employer to the employee during the financial year, the member of the family or the employee has to file Form 1 to the Income Tax Department within 9 months from the end of the financial year or 31st December 2022 for claiming exemption under section 56(2)(10) clause 12. So in case of death of a person who was convicted with COVID-19, within 6 months, if he dies from the date of his COVID positive report, then within 9 months from the end of the financial year, the member of the family has to file Form A or within 9 months from the end of the financial year or 31st December 22, whichever is later, to claim the benefit of exemption of 56(2)(10) subclause 13.
1 minute, just small correction. Small correction. In this, there are 3 circulars.
Okay.
This regarding C. One is regarding the perquisite 17(2), the proviso 2C, where the employee has to give to the employer all these documents what is narrated. There is no Form 1, Form N. Sorry for that. I mean, I will just clarify that. So there is no Form A or Form 1 to be filed by the employee to the employer. So there is no deadline because it's a part of a perquisite that comes to that's one. So other 2 notifications, which is one for the normal treatment expenditure other than the employer or other than the employee, is a normal person as any person. That in that case there is a Form A, and in case of a consideration, I mean in case of amount received in virtue of a death and the amount received, that is Form 1. So that is 2 differentiation. Otherwise, documentation, what is there? This is what just qualification. You see, missed out somewhere.
Yes.
Next, Circular 17 of 2022, that is dated 11 July 22. In exercise to power referred under section 1192, the CBDT has given the powers to Commissioner to condone the delay for filing of Form 9A and Form 10. And the condonation can be taken till 365 days. And the maximum limit that the Commissioner can give it for filing these forms are to 365 days to 3 years.
Which year?
That is starting from assessment year 18-19 and then subsequent years.
What is the number?
Circular 17 to 2022, dated 11 July.
17?
17 20.
July 2020.
11 July 22.
No, number.
17.
Another circular which was released number 16 2022, that was dated 19 July 22, that gave condonation under section 1192 to the Commissioner to have condonation for the filing of Form 10B for assessment year 18-19 and subsequent assessment year. And in the same fashion, Circular 19 was released 19 of 2020, dated 3rd November 2020. That was issued, and the condonation was given to the Commissioner for filing Form 10BB.
Please repeat the numbers of this circular.
Circular 17, which gave condonation for Form 9A and 10. Circular 16 of 2022 gave condonation for Form 10B. And Circular 19 of 2020 gave condonation for Form 10BB. Then a Circular 13 of 2022 inserted a new section of 194S, which gave which suggested that to deduct TDS of 1% on the consideration for the transfer of virtual digital asset, when the consideration is received more than 50,000 during a financial year. And it is coming into effect from 22nd June 2022. No, it's coming from effect from 1st July 2022.
Coming to before I forget, there are two practical aspects I thought we should share with. Though we read income tax law, our all discussions, CPC by coding the entire income tax act into binary mode decides differently, and we'll have to either litigate, correspond, or go 154, etc. In this context, whatever circular our friend has mentioned assume lot of significance. I'll put this way: if in one practical case, the SSE Charitable Trust has filed form number 10B, the auditor has uploaded form number 10B on 17th September. Time to file 10B expires on 30th September. Time to file return is on 31st October. But 17th September itself, 10B uploaded, and thereafter ITR 7 has to be filed. On 17th September itself, in assessee's login, ITR 7 is uploaded. But having gone to assessee's login, that clerk who is uploading inadvertently first uploaded the ITR 7 and thereafter approved form number 10B. Now, 17th September evening 4:30, ITR is filed. 4:31, form number 10B audit report uploaded. Now, section 12A subsection 1 clause B says unless the audit report is filed before the filing of ITR 7, 11 and 12 is not applicable to assessee. So now what happens? 4:30 when the ITR 7 is filed, at that moment system checks whether there is any 10B approved by assessee. At that moment, if no 10B is approved, automatically system says assessee has filed a return without audit report given by the auditor in form number 10B. Therefore, in computing the income, all exemption claimed under 11 and 12 gets rejected. This is how the system reads. Though assessee might have filed the ITR 7 well before the due date of filing the audit report itself, system reads like this. So for these cases, assessee may have to go under mercy plea, not able to file any appeal, etc. For that, this circular will come for rescue. So circular says up to 365 days, the CIT exemption would be entitled to consider the case. After 365 days delay, but up to 3 years, the principal CCIT exemption would be entitled to consider the case. So first 365 days, the jurisdictional PCIT exemption would entertain the claim. After 365 days, up to 3 years, the PCCIT would entertain the claim. This way, this particular provision, that condonation of delay, delegation of authority, would really help these sort of technical cases which one can bear in mind. Okay. Now,
yeah, yes, sir.
Because I thought in practical life, these are all matters where professionally sometimes assessee may not know the outcome, but our members will have sleepless nights because of these technical matters. Therefore, right. I thought we can just have a quick discussion, though it is slightly out of context. Now, as Sharmaji said, we will have to take up class 44 and elaborate some time. Before that, just this one quick practical aspect on this 43B I will discuss, and thereafter I will go to class 44. Take this particular live example. Fixed deposit is made by with a bank for 3 years. Subsequent to that, the assessee was in need of money, and therefore, instead of closing the fixed deposit, he took a loan against the fixed deposit. Now, we all know when we take loan against fixed deposit, the interest on fixed deposit will get accrued. Interest on loan also will get accrued. Upon the maturity date, they will set off both and give the balance number. Now, 43B, on the interest on loan taken from the bank, any loan from the bank. So now the interest accrued up to 31st March. We have not paid because the bank says on interest on deposit also we will consider, interest on loan also will aggregate. On the date of maturity, we will offset both. That's what they understand. So now we take bank loan from bank on against the fixed deposit. appearing on 31st March, before the due date of furnishing return, anyway it is not going to be paid. Does it require to be disallowed? Income from FD will be offered under other sources gross. Interest on loan against FD will be claimed as a deduction. Does it require to be disallowed under 43B for the reason that the interest on this loan is not paid either before the end of the financial year or before the due date of furnishing return? Interestingly, the clause says any sum payable by the assessee as interest on a loan or advance from scheduled bank or a cooperative bank other than PSES, etc., in accordance with the terms and conditions of the agreement governing such loans and advances. So that means, as per the terms, it should have been required to be paid before 31st March. Anything which is required to be paid before the end of the financial year, but not paid before the end of the financial year or before the due date of furnishing return, alone is required to be disallowed. If, as per the terms of the contract itself, this is not required to be discharged before 31st of March of the financial year, because of 43B, one assessee could not be compelled to pay this in order to get the income tax deduction. So, as per the terms and conditions of the agreement governing such loans and advances, if it is otherwise due to be paid before 31st March, but not paid either before the end of the financial year or before the due date of furnishing return, only then it will call for a disallowance, not otherwise. So that is something which one has to take on record. So having said this, we'll take our time on 44 because that will have this. Of course, since if time permits, we'll come back to this. The one practical case, generally we will keep taking.
As for clause E, all the cases wherever the interest is accrued but not due for payment will be excluded, right?
Yeah, accrued but not due for payment on 31st of March now is to be excluded.
Yeah, that's what I'm saying. Yeah. Okay.
And of course, there is one retired ITAT member, Mr. Rajaratnam. He was a member of ITAT from and he had been writing articles, reviewing books, etc. Even Sampatha Yanga's book he has reviewed. He used to say under income tax law, there is no question of accrued but not due. His article will go to say, anything accrued means under income tax law, it should be due. Only then it can be said to be accrued. Accrued but not due is an accounting terminology. Therefore, in accounting, it can come for taxation, accrued and due both be one and the same. So going by that, if it is accounting, we say accrued but not due. For tax purpose, it is not due. Therefore, it is not required to be disallowed.
Correct.
Yes, sir. Mr. Raj Ratnam, many people have forgotten, sir. Though he has written so much, he was writing in article.
Yes. In ITR,
he was writing his comments.
Yes.
And at the age of 85, 90 also he used to write till last day.
Yes, 90. He celebrated his 90th birthday, and thereafter, when COVID started suddenly, not because of COVID starting.
ITAT president once said, Mr. Whenever he was tribunal member, he could smell the brief.
Yes, very knowledgeable, and we had been fortunate enough to have personal discussion and get so much of knowledge from his commentaries.
Yes, sir. Yes, sir. Yeah. Yes. Yes, sir.
Fine. Now, I'm unable to resist my temptation to just to take 1 minute on this slide. Thereafter, I'll go, because after 44, I do not know whether we'll have to go back. This is one question generally our fraternity used to consider, whether section 44B, 43B applicable on a GST outstanding when we are following exclusive method for the purpose of reporting. We do not take it to the credit of income and expenditure or P&L account. Payment are not accounted through the profit and loss account. They are kept in the balance sheet as a collection and payment account. Then in spite whether 43B would be applicable or not. Now, though for accounting purpose, these are shown as collection and payment account. But for the purpose of taxation, it shall be presumed and deemed as if it is routed through the profit and loss account. Saurangi Sales Bureau case, Honorable Supreme Court said amount of sales tax collected should be held to be forming part of trading receipts. The appellant would of course be entitled to claim deduction as and when he pays to state government. The fact that the appellant credited the amount as sales tax under the head collection account would not, in our opinion, make any material difference. It is true nature and quality of the receipt and not the head under which it is entered in the books of account, as would be proved decisive. So therefore, even if we take this to a balance sheet item, it is presumed and deemed as if it is credited, the entire collections are credited to the profit and loss account. Entire remittances are debited to P&L account. To the extent not remitted, by matching concept, we'll have to debit to make it neutralized, credit payable. That is what is appearing in the balance sheet as payable. And that on balance sheet date, what is due? At least before the due date of furnishing return it is settled, fine. If not, it has to be mentioned in 43B. So therefore, making an entry in the books of account as balance sheet item would not make the item outside 43B disclosure. It has to be forming part of 43B disclosure. Now we'll take up class 44 and spend some time.
Yes, sir.
Many more aspects are running in our mind to discuss, but of course time is very short. And now 44, of course, it was extended, and it was believed that this year also this particular clause would be made inapplicable, but that extension did not come, and therefore we are now forced to give the data in the form number 3CD class 44, and it may not have a bearing on the computation of income. Effectively to say, our classes in 44 AB form number 3CD could be divided into certain baskets. Some of them are only information in nature, may have some other consequences, but not have any bearing on the computation of income. This is one such clause, but we have a bearing on something else to do some analysis, etc. Now, when originally GST came with a reverse charge mechanism, and also we had unregistered dealer, you purchase something and you have to pay everything on a reverse charge mechanism, these particular classes may have some relevances, but of course now that that particular provision went away and GST returns take care of all this information, the 3CD asking all this information is, in my personal view, is a duplication exercise. This could have been discussed in GST returns itself, asking us to file form number 9, there itself it could have been added, but our income tax forms are getting overburdened with other legislature related requirements wherever it is possible for them to collect information. So now our institute guidance note says, first, this particular expense, the language used here is expenditure. Effectively what is said is expenditure. So now in income tax law we have three phrases: deduction towards expenditure, deduction towards allowance, deduction towards a loss. Expenditure is something we voluntarily pay out of pocket. Loss is something involuntarily devolves on assessee. Allowance is neither expenditure nor loss, but allowance is granted to the assessee by legislature. So expenditure, traveling expense, voluntarily incurred. Loss, bad debt, loss. Allowance, depreciation, statutorily conferred on the assessee. Now that all the three, what now comes is only expenditure. So anything debited to profit and loss account by way of an allowance or by way of a loss, transaction related losses, they are not required to be reported under this particular table. That's the first point which we will have to keep it in our mind. What is discussed is only an expenditure, not allowances, not loss. That means bad debt, discount given to sundry debtor, all that will not form part of this discussion at all. Expenditure alone would come there. Now the expenditure is now sought to be divided into baskets. Expenditure incurred from and payment made therefore for a registered segment, unregistered segment, total. Now there are cases where we are incurring expenditure on a mercantile system. So from unregistered segment, we have got expenditure incurred. From registered segment, we have got expenditure. This registered segment is further subdivided. So unregistered all in one basket. We are dealing with unregistered people. We are incurring expenditure. They are otherwise, the nature of activity is such that it is registrable, but for some reason exemption is provided from registration. Therefore, it is not registered. For unregistered people, dealing one segment. Registered segment that is required to be further divided into exempt people, composite people, others. So now these three to be aggregated and say how much is total. So now in the total, unfortunately, the form says payment made to. So first three, within the registered, the three baskets, exempt people, compound cases, and registered others, other than these two. A total should match, but there it says payment, not expenditure. So that means we incur expenditure for which we make part payment. If we put part payment there, the total will not match. Therefore, our institute guidance note says, even though language used in the fourth column is payment for this aggregation of these three, it has to be read as expenditure, not payment. Payment paid includes payable. That theory we will have to adopt so that the numericals will match proper. So now it is on due basis we are picking up so long as the SC follows mercantile system of accounting. Payment, even though the language used is payment for one column, we'll have to see everything as expenditure. Then this language employed is expenditure. Therefore, expenditure may be on a revenue account or on a capital account, irrespective of which we have to factor it. So that means what we need to do, and there are the tax audit quality review board has mentioned in TDS related observation. In TDS class 34, we will say 194C how much, 194J how much. Section wise we aggregate. But sometimes there may be payments covering under that section, but not falling under revenue account. We will make a payment for construction of a building, for which we'll apply 194C. We'll aggregate and report under one row. So some comments have come to say your current year debit to P&L account, which will otherwise come under 194C itself very less. But your 194C related reporting in form number in class 34 appears big. So there is a prima facie appearing something wrong. In order not to have such look, what we can do, all revenue items will have one row. All capital items will have another row. Though same section 194C or 194J or 194I, so that at least we are able to say these revenue items matching with the income and expenditure account or a P&L account as the case may be. Same way in class 44 also, revenue items will have one row, capital items, capital expenditure with the same category, dealing with unregistered people, dealing with registered people, but exempt transaction, compounding associates and other registered people will have capital separately. Now, expenditure, does it include purchase? We have very old Supreme Court judgment in Athar Singh Gurmukh Singh case. If expenditure includes purchases, therefore purchases have to be factored. It is not that only expense other than purchase we can count. We have to also have purchases also we have to consider. Now expenditure, revenue, capital, with these bifurcations we will have to call out. Fairly when doing audit exercise on this, we can rely on the reportings made either in the monthly return or in the periodical return filed, if at all they are available before our audit gets concluded. But in some cases where the returns may not contain all the information appropriately, or the software maintained by us may not able to generate the reports as we expect it to be. In those cases, it will be throwing open certain challenges in verifying the numbers. So now if the assessee, on the belief that this may not come immediately, it will take some more time, therefore he has not tuned his software and the volume is high, where he is unable to give up very meaningful information, then the resort only would be to give a disclaimer. But if he is able to generate numbers but adequate documentation is not available for us to verify the correctness of the same, he can go with the number, but para 5 of 3CB or para 3 of 3CA, we will have to say, similar to what we say in 48.3 or 269 SST, though SA has mentioned something on that, but we are unable to verify the same, considering the fact that he has not got adequate documentation, is something which we'll have to rely on. And in classifying between compounding cases, exempt cases, or the cases which are regularly taxable from taxable entities, sometimes the documentation may not be robust. There some challenges will come. Some Excel exercise we have to do and do it. The last column is from non-taxable cases. Fine. There is one view came from the board. Our guidance note is that anything which is neither a service nor a good should not come within this particular table itself. According to GST Act, in Schedule 3, salary paid to employee because of employer-employee relationship, that will not come within the purview of GST at all. So those cases we should not figure out here itself. So our institute guidance note says that should not get figured out at all. So considering that, salary paid by employer to employee should not get figured out. Other cases, those Schedule 3 items having removed, there are other things like court, etc., or so many small other things. Leaving that, all other things we'll have to figure out. And if adequate documentation is not available to substantiate this information, then the option would be to give a suitable disclaimer in para 3 of 3CA or para 5 of 3CB. Now, there is one query raised. I would like to take up that. If somebody showed hands. And one more aspect is this advance payments. Advance payment is only, it may be liable for GST, but of course it's only advance payment. It is not expenditure incurred. Therefore, it may not fit into this, and therefore it would not figure out. And of course, Uttamji would like to raise hand.
About the salary, as you rightly say, in this guidance note, they have clarified. In the draft, exposure draft, I think there was some issue.
But the latest version says salary will not form part of.
Now it has said. One issue is about the interest. Interest. Interest, what will be the position? Interest to bank particularly.
Interest, actually, interest is an expenditure. And if it is a transaction exempt, under that category it has to come. It is not a transaction, neither service nor goods. Law is not applicable, so therefore it will come under that exempt category.
Shall I now proceed?
Yeah, Ustamji.
Sir. What is your view when you are saying that this tax audit entire scenario is for computing the total income of the assessee, or if you go back to the 1984 memorandum, which says that the intention is to get the officer the entire information readily available for computing the income. Now, whatever information called for in clause 44, how it is relevant for computing the income?
I agree, Uttamji, but as I said at the beginning, the Form 3CD was originally coined with hardly 4 pages A4 sheet for the purpose of enabling the assessing officer to compute income. But the form became thicker. Again and again, classes are added. Alphanumeric classes are added. And we have so many such information like quantitative details.
So my intention is to say that when you put a disclaimer, put this as the main clause reason. Put this as the main reason saying why this is either filled up not properly or not filled up at all, or if it all even filled up, you are not able to verify seeing the scenario in which it has been called for. That is the intention.
Right.
Yeah, well taken.
Thank you.
No, issue is raised is, if suppose you don't give these details, what is the consequence?
See that if the assessee is unable to give the details, our job is to say that the assessee is unable to give the details. We cannot be penalized when there is a clause not filled up. If the information is readily available, assessee is not filling up, and we are also keeping silent on it, then only the issue would come. If in para 3 of 3CA or para 5 of 3CB we have drawn the attention, our job is over.
Yeah.
And the problem is for assessee not properly filling up, but we do not have any problem on that.
Right. Even as Uttamji was saying, for SSC also, what is the consequence? Because it is not related to computation of income.
And he can always say, this is not having a bearing on the total income computation, therefore nothing to worry.
Yeah, what you say, Mahendra bhai?
Yeah, I would rather support the view what Uttamji is trying to say, but in a more dignified manner, not directly hurting them, but in a dignified manner, it can be said that the specific details are not available with the client or are not maintained.
See,
And
sir, if you are going to say it is not maintained, a view can be taken that the books are not properly maintained and the books can be rejected.
No. The books are properly maintained as per the provisions of section 145A. So it's not that they are not maintained. The books are required to be maintained in such a way that your proper profit and loss account is drawn up. This is what the law says to maintain the books of account. Law does not say that these specific details what are required under clause 44, you are supposed to maintain your books of account. There are different laws in India for carrying out your business. So for all the laws, you don't have to maintain separate books of accounts. You have a separate computation theory for that, for all under different laws. So therefore, I would not agree with the view that your books of accounts can be rejected if this particular details under this particular clauses are not given.
Or 10 minutes, we can say at the time of audit, we have conducted only that, and this details were under preparation. So it is not.
All right,
it is
for
not
first year, maybe Dinesh bhai, yes, you can say that. But then second year, you will not be able to repeat. If you want to repeat, then next year also I don't want to give, then don't give this clause.
Can we say it is difficult to compile the data?
Absolutely. And it's not relevant.
Because unless GST audit is
This is
completed, it
right
will
now
not be
something,
possible.
this is something similar to day-to-day stock register.
Exactly.
So we are writing SSC has not maintained a quantity register. Nothing is taken. They are not doing anything, taking cognizance.
We have to write in 3CB or
Or they
3CA.
are going by GP.
Do we have to write in 3CB or 3CA?
Both the
Yeah.
places you should give appropriate disclosure.
PCB is must.
So,
Yeah,
sir, it may be out of context right now, but
GST law, but interest you have advised that yes, it's an exempt item under GST. Is the same case for the salary and wages also, or is it different?
No, salary also, because it comes under Schedule 3, payment to, principal and.
No, but then, and the same treatment like salary can be given to interest.
No, I don't know whether it is the same category under GST law, because if it is in the same category, then we cannot have a different view for interest and salary. But if it is in a different category, like how Sharmaji says Schedule 3 and whatever, that I don't know.
No, I was listening to one Mr. Pramod Jain, his central council member. He said interest to bank only is to be reported. I don't know why he said that. His video is available,
Okay.
so that we have to study.
All right.
Yeah. Yes, sir.
And
Any
third,
other?
what about the capital? According to you, Ramnaji, capital expenditure is not to be covered in this clause.
Covered.
To be covered, but in my view, there is the same line. If you aggregate, it is a nuisance. What I would suggest, all revenue, see, one line for all revenue item, one line for all capex.
So I don't know whether the utility has this facility to give
yes,
it.
it has. It has. You can add as many lines as you want.
Okay. That makes sense.
And that is what the guidance note also says, all revenue separately, all capital separate.
And what about the prepaid expenditure? I understand outstanding. Partly it is in profit and loss, and partly it is in balance sheet.
Correct. Prepaid and
To the extent partly in P&L account will show on the revenue, partly in balance sheet, capital expenditure will show.
It's not
capital, no?
No, it is
Capital expenditure does not mean fixed asset related, sir. Anything appearing in balance sheet also we can show.
No, sir.
The fact is that this particular information,
Say prepaid
P&L
insurance,
reconciliation is very
so
difficult.
many items.
So I don't know how the government is going to use it.
No, reconciliation is not necessary, I'm told.
Not necessary,
Yeah.
but so utility value of this information is,
But how do you satisfy that that is correct without doing a reconciliation?
So we keep a max to max. I think so. As a working paper, you keep a reconciliation in part of your working paper.
Right.
But whether you try to show that much transparency in showing full transparency on the moon, maybe sometimes you may fall back.
And one thing they have said is you have to give total. For your purposes, you can maintain the different items, but you have to give total of the expense, total of the expenditure, the revenue
No, but if
capital.
that total is not matching, then there is no point in giving total of
No,
expenditure.
that is what we are saying, this disclaimer.
Exempt, non-exempt.
No, total, if it there's a mismatch, there's one column, now you can put in that what registered.
One thing is about,
Unregistered.
what about this composition scheme dealer?
Now the question is, if the assessee himself is a composition dealer, for the outflow he is under composition. For his purchases, he can fill up this.
Okay.
No. I think there is one column where you have made purchases or expenditures from the composite dealer.
Yes, sir.
Then
See, our outflow has to be further subdivided between the person from whom regularly I purchase on a normal rate, from a composition dealer what I purchase, from exempt people what I purchase, from unregistered people what I purchase.
Yeah.
Yes, because I am a composition opted personality, this particular requirement is not dispensed with.
Correct, but we may have to give a disclaimer saying that I am a composition dealer or I am a dealer who is not liable under GST law, and accordingly I have not maintained this information because it is not relevant for me, even under the other law.
I think there is some misunderstanding.
Yes.
The question is different.
the question is related to my expenditures.
From composition.
So
dealer.
if I have incurred any expenditure, so let me, for clarification, by way of an example, I am saying I have purchased chai masala tea bags from a regular vendor who is otherwise a registered dealer, which is debited to my staff welfare. However, he is a composite dealer, so he's I do not get a credit for that GST element. In that case, we will show this expenditure of GST connected under the composite dealer. So I need to verify each and every invoice to give a true and correct information under this clause. Am I right?
Correct, sir. You are right.
तो 31st September तो क्या साहब ज़्यादा है?
They are maintaining GST, no, register. They are maintaining entry from regular, but the exempt composition.
So we are supposed to pick up the information from that register. We are not supposed to go through each and every invoice and decide whether this person is a composite dealer or this we have purchased.
So GST, whatever GST returns you have filed gives this information?
Yeah.
No.
If it is filled up properly, because in most of the cases,
Assuming it is.
yeah, no, most of the
Assuming that they are
not connected, SSEs won't maintain, the registration, that is for registration.
No, but I am told that all these details are not there in the GST return.
That's why.
It is not there. Only
Yeah.
if the accounting software is robust and all this information are captured in that accounting software, then you will be able to generate the report. Otherwise, you have to go only by presumption.
No, that means if we make the software robust, next year we will be able to give. This year we'll have to go with a disclaimer.
That's what precisely I'm trying to say. Yeah.
Yeah, that clause,
Right.
otherwise that clause 30C, sir.
Sir, 30C, I think going by the size in practicality, if there are any questions, we'll take up, sir.
So
Yeah.
before that, a basic question regarding the applicability of this clause, whether it is applicable for this assessment year, forget the guidance note. Leave aside the guidance note for a moment. What is your view?
No, I personally lean towards it, sir. I would like to go with guidance.
Okay.
No, I am told if you see the history, in 18 it has come up to, it was extended up to 31/3/19, then 2021, so it is applicable. Yeah.
Signing the report, that is important.
Yeah, as regard 30C, sir, impermissible arrangement.
Avoidance agreement.
Assessing, we said, so what guidance note has said, you should see whether in the last year anything has been done by the assessing officer and the similar transaction is there in this year or not.
Yeah, going by past records.
Right, sir. So now other clauses, sir, you can just take important points. Maybe.
Okay, now I will just take to one question which has come in the chat box.
Yes, sir.
Clarify third proviso to 44AB subsection 1. particularly in the case of an existing company having a turnover between 1 crore to 10 crore, are they required to carry out audit? Third proviso is only talking about not requiring to carry out an audit under Income Tax Act, where audit is already available under other act. That audit report can be borrowed as it is, subject to financial year is one and the same. Now coming to the audit under Income Tax Act for the purpose of 44AB, we will between 1 to 10 crore turnover, we will have to see whether the assessee satisfies the condition of proviso below clause A. If 1 to 10 crore turnover, less than 5% or less cash transaction, both debit and credit, in that case, even if he is liable to audit under any other law, he is not required to get accounts audited under income tax law. When he is liable to audit under any other law, without income tax audit, the return can go. So 44AB will not come. Normal return, assessee's return would go. So that's all. There is so long as the condition of 5% or less cash transaction is dealt with, there is no problem in this case. 44AB class A will not apply for him.
So, but for a turnover of 1 to 10 crore, the condition of 6% or 8% is not applicable, right?
Not applicable because it's a limited company, sir. Because that particular condition will not apply to a company at all. 44 AD would apply only for an eligibility who is an individual, HUF, partnership, other than LLP, all being resident. So an LLP or a limited company, AOP, BOI cannot come under 44 AD at all. So therefore, is being a limited company, we don't worry about application of 44 AD.
Sir, in one of your slides for 48.2, there you have categorically excluded not to include capital expenditure. So here the payments are distinguished in context to clause 44 and in context to this clause.
Yes,
are
sir.
you contradicting?
No, I'll just go to that slide.
So there what is allowable is revenue expenditure. Under section.
The section says expenditure in the payment.
48.
See, in respect of 48.2, the section says a deduction for a payment in respect of an expenditure, which is otherwise allowable there.
Yeah.
But here in 44, it is calling of information.
Right.
So therefore, the language expenditure there is otherwise allowable. 48.2, it is otherwise allowable. Therefore, only debit side P&L account 48.2 transactions we have to capture. For the same party, if we have income side transaction, we are not required to worry under 48.2 reporting. Similarly, for the same party, we purchase a plant and machinery from him. That is not required to be reported here.
Right.
And it is expenditure again. So expenditure means voluntarily it should go out of our pocket. So the discount given for a debtor who is a related party, it is abatement of sales price. It is not a payment made by us, it is allowing him not to pay the balance. Therefore, it is not payment. So trade discount or cash discount given to a related party is not required to be considered under 48.2.
No, but my only small question is both the clauses ask about the expenditure. So when in one clause you are saying not to report the capital expenditure, the other clause you are saying to report the capital expenditure. And I appreciate that this is what possibly the guidance note would be saying or talking about. But independent of guidance note, what are as an auditor, what are we supposed to report on?
Sir, now coming to the purpose, 48.2 is enabling the officer to say whether the payments are reasonable or not, considering the three important parameters.
Okay. There are other clauses, yeah.
If assuming for a moment I purchase a plant and machinery, 48.2 will not enable him to disturb the transaction value. The enabling provision will be 43 clause 1 explanation 3.
Here 44 depreciation will not come.
44 depreciation will not come because it's the allowance.
The depreciation.
So there is a computation effect. What I'm trying to say, on the contrary, in clause 40,
there is a computation effect, sir, but 48.2 is not the enabling provision to disturb. The enabling provision to disturb the transaction value with reference to purchase of fixed asset would be 43 clause 1 explanation 3 or 3A. That is not figured out here. And the issue could be well appreciated in case where we had domestic transfer pricing transactions for 48. When domestic transfer pricing issue was there, whether we have to take for the purpose of applicability only the revenue transaction with related party or even the capital transaction with the related party for the purpose of deciding whether domestic transfer pricing rule would apply or not. Now, assuming capital transaction is taken up under 48, the officer cannot disturb the transaction value. If we purchase plant and machinery from a related party, 48 is only the enabling provision under which the disallowance cannot take place. Therefore, even for domestic transfer pricing, only revenue related transaction has to be factored.
Okay, sir. Right, sir.
Sir, principal waiver of loan, you are referred to that Mahindra and Mahindra.
Yes, sir.
41(1) and section 28 doesn't apply.
224(18), 28 class 4, 41(1), all would not apply.
What about 56 to
56 also would not apply because effectively there must be no consideration. Here waiver has got a host of conditions, one-time settlement, paying something in order to leave the balance. All that will be consideration for getting this.
In loans and deposits, you are raised, sir, whether the selling is to be seen for per annum, per month, per day, per transaction. What is your view, sir?
It should be for 216 SS. Sharmaji, you are referring that question?
Yeah, yes, sir.
2 minutes I will say for the applicability part.
So because time is,
but let everybody be with you, na?
Yeah, I'm just, if you understand the issue, yeah. Yes, sir.
Yes, of course, I should be burdened for having this element to mentioning, but still, what I used to say in my classes, I'm just quickly saying, for the purpose of this 216 SS, receipt of money by way of loan or borrowing or specified sum, ceiling is 20,000. Now, on that particular ledger account, before receiving money, if there is already opening balance, we'll just see the opening balance. If that opening balance is already reached or crossed 20,000, the subsequent receipt should always be otherwise than in cash through instrument or account payee, ECS, etc. If the opening balance doesn't reach that amount, 20,000 ceiling, but current in transaction what we receive, that and opening put together, the closing reaches or crosses 20, this transaction should be only through instrument. If the opening balance is less than 20, after the current transaction, closing also falls less than 20, then the current transaction can be in any form, cash or non-cash. No problem. Coming to the repayment part, if the balance before the transaction takes place, the balance happens to be more than 20, this transaction should be only through permitted mode. If the balance before making the transaction is less than 20, this payment can be in any mode. This is how we will have to see. It is not per day, per occasion, etc. Every transaction, before doing the transaction, we'll have to see the opening balance, see the closing balance, and accordingly we should decide the section is applicable or not.
Yes, sir. Anything? Any other few points? Just 5 minutes, sir.
Only one aspect here I would like to say on a practical note. There are some proprietary assessees where they maintain books of account both for business and personal transactions, SB account interest, some rental income, and in accounting, in order to show the proper profit from the business, they take to the credit of the capital account these rental income and say SB interest. Some cases in class 13, these rental income and SB interest were shown as other income, not credited to profit and loss account. Though the rental income or sometimes capital gains and SB interest were shown in their respective head of income, but they started receiving CPC notices saying, auditor said these other income not credited to P&L account, but your return doesn't contain, therefore we are proposing to add it. CPC unable to link these are otherwise included in the other heads of income. So therefore the proper course of action is not to either report under class 13 or take it in the P&L account, dismiss from the computation of business income, and consider separately under other rates of income so that this notices from CPC could be avoided. Otherwise, it will be amounting to double.
Sir, by taking it into P&L account, the problem is then as a chartered accountant or as an auditor, you are certifying those receipts or you have to verify those receipts, whether those receipts are properly accounted, correctly accounted, ABCD. So instead, that is the first option given by you is better, no?
Yeah.
As an auditor, the first option is better.
Yeah. It depends. If everything has come in bank and it is credited to income and expenditure account, no issue. If it is cash related, taken to the capital account, our certificate will be confined into business transaction. To that extent, it will be good. But giving in clause 13 in spite of offering under house property other sources would result in technically receiving notice from CPC and troubling. And thereafter, how much ever clarification we give, that notice continues and will end up with only paying taxes and there not paying but resulting in demand and thereafter fighting for 154 etc.
So better way, I think, to capital account, to profit and loss account.
Normally what we do is
Personal capital account.
Yeah, take it to capital account, but not reporting under clause 13 is appropriate.
Then we can avoid this.
normally what we do in 3CB itself, we write a note that
Okay.
this includes only the transaction pertaining to the proprietary concern. Any personal item of information is not part of this audit report.
So that is what, as an auditor, you are clarifying it. But what is sir trying to say is that in that case, you are going to invite this adjustment notice 143(1)(a).
I will put in there, we have audited only
Still then,
business.
this is his opinion, not.
Yes,
Yes,
sir.
sir. Any other such clarification, sir? What the review board has pointed out, saying that commonly errors what the chartered
Common errors, of course, that by itself is a study, sir. But only one aspect is SA 700 comes with certain disclosure. What is our scope? What is the scope of the assessee? But Form 3CB doesn't have. Form 3CA relies on the audit report of other statute where we will give that. In Form 3CB, there is no clause specifically saying that. Therefore, whatever the scope limitation described in SA 700, we will have to say in para 5 of 3CB is what the TAQRB says. In some cases, that is referred but not mentioned, or it is mentioned as if given separately but not given separately. Therefore, better we'll make this as an annexure A, as a first note to para 5 of 3CB. And what SA 700 model versus 3CB, whatever limited left over, all that will say the responsibility of the assessee, responsibility of the auditor, and all that will incorporate so that tomorrow, as per the institute pronouncements, we are not falling short. And there are like 50C, 56 to 10, chapter 6A, the written may contain all the information of the assessee of that year, which may come from business transaction, may not come from business transaction, but we will be confining ourselves to do only audit of the business books. So therefore, if there is 150C transaction by the assessee, in clause 17, we are not required to report if it is not figured out in the business books. Similarly, 29B, if at all there is a 56 to 10 transaction, we are not required to report. But in the return of income, we will have to incorporate all these things because we follow certain software. Moment we fill up the return of income, it will automatically come in the 3CD. So they are interlinked. And if at all we remove from the return, the 3CD also it will not figure out, in the return also it will not figure out. In a case where like 50C, 56 to 10 or chapter 6A, let us say in chapter 6A, some transaction, personal bank account from which he has given mediclaim, that is figured out in chapter 6A. But we are not required to mention it. But in, if at all the software is interlinked, what we type in chapter 6A will automatically come in Form 3CD. So to do that year carefully, we'll have to create one file for 3CD, one file for ITR, and carefully in the 3CD file, these sort of personal information should not be mentioned so that our 3CD will be proper. And in the income tax return, all these things should be mentioned and it has to be appropriately uploaded. This fact we have to take care of it.
Sir, one small question.
Yes, sir.
Of course, I may be wrong. I'm just trying to understand whether they are asking the question related to 56 to 7B.
Yes.
9
7 is gone.
10 they have said. Have they included 10 also in 3CD?
Yes, sir, they have included 29B.
29B.
Clause 29, 29A, 29B, they have included 29B.
Oh, yeah. Yeah, they have.
Sir, in this firm and AOP, that slide, you have said Munjal Sales Corporation.
One second, Uttamji would like to say something on the earlier concluded point.
Yeah. Sir, one issue, whether a physical copy has to be given or not to be given.
Physical copy after uploading.
Physical copy, whether in the utility format or it has to be in the notified format.
Very interesting proposition, Uttamji.
Department.
In the utility notified format, there are certain changes as compared to what is given in the Gazette, whatever is notified in the idea form. So when we start filling up the data and fill up properly as per that, and what we will not be able to do the same exercise in the utility. So if you take utility copy and give it, whatever given in the statute, we will not be giving it. But what we have communicated through portal, if you give that, there is nothing wrong in it. But if the assessee would like to cautiously, the auditor would like to cautiously take the form as mentioned in the rules and fill up that and want to do physically, okay. But what is given physically, the same version will not be there in the portal. That difference will remain.
See, what guidance note is saying is you have to give, because that is the difference between the utility and the notified form. The utility, as well as there is one more issue which is there, which I would like to Ramnath sir to answer.
Before you
Whether
read,
online filing.
what does the guidance note say? We are supposed to give utility wala form?
No, guidance note says the physical form shall be issued as notified by the department, not as per the utility.
Yeah. Okay. Thank you.
And one more thing is whether online filing is compulsory, whether it is authorized by law.
Yes. Why now?
You are planning to invite a classic case of litigation.
Why there is a doubt?
No, but Uttamji, you say so. 4480.
Yeah, for tax audit, the section is 44AB, the rule is 6G, the form are 3CB, 3CA, and 3CD. The rule only says these are the forms in which the return has the details have to be filed and the particulars have to be given in form 3CD. Nowhere it says that it has to be filed online. Now, where did the department are coming out? They are coming out by Rule 12. In Rule 12, as a proviso also they are coming. It is not as a main section, it's a proviso in Rule 12. But if you read Rule 12, it pertains to 139, which is return filing. And if you go to 139, there is a provision 139 capital C and 139 capital D. 139 capital C says nothing to be filed with the return of income. 139 D says whenever the assessing officer asks for, you give the copy of the same. So in case if you have not filed and the assessing officer wants to levy any penalty, you have a way out.
Oh, good.
Uttamji, there is 2009 when the first time the online has come. There is a notification content, right? There's all paperless returns to be filed and this is to file. Does it?
Sir, if you go to the rules, and there is a rule number 130 and 131, which was inserted in 2021. And that rule 130 and 131 takes the power to make everything online. However, there are many forms which are not prescribed online, but the department has gone ahead and done everything through different rules, which are maybe not correct.
Right.
Good, yeah.
Sir, there is one question from Mr. Yash Nagar. In case of non-corporate assessees, what care should be taken for clause regarding interest due on MSME vendors?
Fine. See, the financials, if the two aspects are, first, if they have to collect information from the vendor that they are MSME, if the assessee has got evidence to suggest he has asked for it, but the other side has not responded yet, then to that extent he can say there is no information for the other side, therefore I would regard these people as non-MSME. And if there is any interest paid to MSME and he has charged to profit and loss account, that interest paid has to be disallowed. If he has not paid any interest, even though they are MSME, this gentleman has not, this assessee has not paid any interest. Since there is no claim of interest paid, nothing is required to be disallowed. But the size is such that there are good amount of information to say these are all MSME people from whom he is dealing with, and there are outstanding payments beyond 90 days and interest is otherwise due, he has not paid, but the amount is sizable, then the truthness and fairness of accounts would be in question. In that case, a qualified report may be required for the purpose of closing the financials. But since no provision, no payment made in the books for payment of interest, in such case, no disallowance would be warranted. To the extent actually paid, debited to P&L account, disallowance. If provision is made but not paid, the provision calls for disallowance because of this particular provision.
Sir, in this form AOP slide, disallowance under 40B, 40BA, you have referred to Munjal Sales Corporation Supreme Court.
Yes.
In what context it is, sir?
Fine, sir. That's a judgment where now 40B versus 36 and 37. That principle is laid out by the Supreme Court in that judgment. What Supreme Court said, 40B is not the enabling provision. 40B is a restricting provision, rather disabling provision. It starts with a negative note. So to enable a provision, enable a payment of interest or a remuneration, the enabling provision is section 36 and 37. 36(1)(3) is the provision enabling for payment of interest. 37 is the enabling provision for payment of remuneration. So the condition of 36(1)(3) and condition of 37 should first be satisfied. 37 laid out wholly and exclusively for the purpose of business or profession, not being capital, not being personal, not covered under 30 to 36. 36(1)(3), the money borrowed for the purpose of business or profession in respect of which this interest is expended. That condition first we have to satisfy. Then additional conditions have to be satisfied if at all the payment relates to partner. If it is a third party, those conditions are sufficient. If it is for a partner, additional conditions are satisfied. Therefore, as deed provides, merely because deed provides and payments are made, that by itself would not enable the assessee to claim. First, those primary conditions have to be satisfied factually, and then the assessee has to further satisfy the conditions contemplated in 40B, 1 clause A, B, C, D, etc. Thereafter, he has to satisfy 12% interest prospectively, depending on authorization by the deed. These additional conditions for a remuneration, working partner, all that being an individual, all that additional condition. So, Munjal Sales Corporation, Supreme Court said, merely because you satisfy 40 small b condition, you will not be able to say that 36 and 33 cannot be questioned. It has to be first satisfied. Additionally, you have to satisfy these conditions.
Right.
Okay,
Yeah.
sir, I have a question on this, very much relevant one. So in this case, since very correctly you said that 40B talks about the restriction. So if the deed provides that 12% interest is to be given to the partners, and as per the provisions of 36, read with section 40B, if the interest is paid at the rate of 9% without drawing any subsequent supplementary deed, would that be allowable or not?
Sir, now payment is authorized by and in accordance with the instrument of partnership.
Yeah, but that talks in 40B.
Yeah.
Not.
So first under 36(1)(3), 9% is allowable.
Yes.
But under 40B it will not be allowable.
But 40B talks that anything less than 12%, but not in, but which will not be in accordance with the deed.
Yeah. The payment should be authorized by and in accordance with the terms of the instrument of partnership.
Yeah.
So now this payment is authorized by the terms of the partnership deed, but not in accordance with the terms of partnership deed.
So it will not be allowed.
Yes.
So it will be treated as AOP?
No, this interest will not be allowed. That's all.
Just a twist to the facts to this question. Say I have a practice of the deed provides quarterly credit of interest. So I credit for first 3 quarters, don't credit for 4th quarter. The ultimate outcome is same what Mahendra said, that 9% effect. So in this scenario, what is your view?
Sir, your voice is echoing. I'm unable to get the entire question.
Yeah, his question is that for first 4, the policy of the firm is that every quarter the interest is credited to the partner's account. So first 3 quarters, the interest is credited at the rate of 12%. The 4th quarter, no interest is credited on the partner's account, turning out to be the average 12 months, 9%. But in such case, in this type of scenario, what will be the situation?
Now, if the deed says 12% per annum and very absolute term, interest is charged. The deed is in a very absolute term without giving any leverage or any option. Then this 9% what is paid also, assessing officer would try to disallow, and it is a litigating subject. As can say, first 3 quarters I followed what deed said. Last quarter only I did not follow. But it is open for definitely issue. But I would agree that first 3 quarters they have followed.
Right, right. It's a good question. Right.
It's all dependent on how you draft your deed.
No. So the deed, if you keep it open-ended, then there is a problem.
No, we can say that interest will be paid at such rate or rates as may be mutually decided from time to time, not exceeding 12%.
No, that is not.
No, that is not allowed anymore. Because it's not clarifying that there are decisions to say that you should, the deed should be drafted in such a way which clearly mentions what the firm is supposed to pay to the partners. So I don't think so that will work now anymore. Now, before that, I have one small, it's not coming out of any new law or new amendment, but supposing I have not gone through the new guidance note, and very commonly it is affecting everybody. So I would like to take it, if the Sharmaji permits.
Yeah, sure.
It will take another 2-3 minutes.
Yeah, sure.
All right. It is regarding clause 14A. Clause 14A of 3CD, which reads that method of valuation of closing stock employed in the previous year, very clear, no issues. 14B talks about deviations to section 145A, and if there is a deviation, which I would say in all the cases, if a person is following accounting standard 2, it has to be a deviation, and accounting standard 2, our institute says that it has to be exclusive, whereas 145A says it has to be inclusive. Now, if I'm following that, I'm not following 145A, but however, there are number of judicial pronouncements which says that even if you are not following inclusive, still there will not be any impact on the profit of the SSE. Same way, even our guidance note has been saying that there is no impact. So if I give just 2-liner saying that there is no impact, would that be okay, or do I have to give the entire working which form 3 for clause 14B talks about?
Very interesting question, sir. In the earlier version of the guidance note, they illustrated with example.
Yes.
The present guidance note, they have taken away the example, but the conclusion they have retained as it is.
So good. So I think so. If this, because this otherwise takes too much of time to give the details.
Yes.
So if according to, I just wanted to confirm that only. Whether
They have taken away the example, but they have retained the conclusion saying that it is revenue neutral. So we will, instead of we ourselves declaring that it is revenue neutral, consciously will say, according to para of the guidance note, it is revenue neutral. Therefore, the assay has not furnished the information.
All right.
So that we will rely on our guidance note instead of we.
26.16. 26.16 of the guidance note.
Yes, para 26.16 of the guidance note.
Yeah.
Uttam Ji would be the right person to reproduce the entire language which he usually says.
Not taking remuneration more than 1 crore.
But now they have said,
Yeah.
yeah.
So we can safely now avoid,
Yeah.
Sorry.
otherwise.
Partners getting remuneration more than prescribed limits. No audit is required. It's a firm's business. Hello.
Yeah, there is one query here.
Hello.
Yeah, Sharmaji.
The question is, partner getting remuneration more than prescribed limit. There are judgments, I think.
Direct judgment of Bombay High Court, when 263 opened, matter went to Bombay High Court, straight away they said it is firm's transaction, it is not the partner who is carrying on, therefore it is not applicable, audit not applicable.
Right.
Although expenditure is claimed against that remuneration.
Yeah, that is possible. Expenditure can be claimed, but that will not read as turnover or gross receipt. Therefore, audit is not applicable.
Claiming expenditure, we invite provisions of 14A.
Yeah, we will, because you have share income. Therefore, you will have to suitably factor the impact of 14A on the expenditure so claimed.
Yeah, that will be more difficult.
So, should we close?
Yes.
Only one aspect, sir. This slide, if you see, allowability in case of cash basis. In real life scenario, certain assessees will follow cash basis, predominantly people doing money lending. These partnership firms, interest and remuneration, usually going by the deed, it will be credited and thereafter gradually it is drawn. If the assessee is following cash basis for all other expenses, for interest and remuneration alone, as per the deed, if the debit is made on expenses, credit is made on the partner account, then that will also be subjected to the application of cash basis. To the extent amount drawn only will be allowed. and the amount not drawn left over in the account will not be allowed. This generally gets unnoticed. Therefore, I thought it is appropriate to.
Yeah, good, you brought it to the notice. Very rightly, it goes unnoticed.
And one another aspect is in firm's case, sometimes family members will be in the firm, some son and daughter, and without the knowledge of the auditor, they will go to abroad and that will never get noticed and informed to the auditor. Interest and salary will be accounted in the books of the firm. If it's a partnership firm where resident partner interest added, 194A(3) will provide for exception not to leave it ADS. But if he's becoming a non-resident, he has gone for foreign studies for 1 year and interest kept on added, in that case, he is a non-resident, therefore 194A(3) will not apply, 195 will come, tax not deducted, therefore 40A(1) would come. This is another important aspect. When family-run firms have got sons and daughters in a partnership, we'll have to have a question before completing that. Otherwise, the only option is they have to file return, and Hindustan Coca-Cola, we have to rely on to say the other person has reported, even for 40A(1), disallowance should not come. This is also one practical aspect we'll have to keep in mind when family members, family-run concerns, son and daughters taken into partnership.
Is this proviso made applicable to 40A(1) also, or it's only to 40A(1)A?
40A(1) doesn't give it. So therefore, even proviso is not there. Honorable Supreme Court in Hindustan Coca-Cola said purpose is the other person doesn't pay, therefore you pay. When other person has already paid, why should you be penalized?
Yeah, the department will take a view that well, after this Hindustan Coca-Cola, the legislature has made amendment to 40A(1)A only and not to 40A(1). So therefore, they will. It will be definitely litigated.
Yeah. At least we have a case to say the other person has reported. Once again, you should not ask to deduct. That at least we have a case. But if it is taken care of at the beginning, this could be avoided.
Right, sir.
Either we don't need write interest on them, or we'll deduct tax and file their return. Anyway, we will be filing return for them. But if it get unnoticed, here we will account, there will pay self-assessment tax, thereafter TDS nuisance will come, or disallowance nuisance will come. That could be avoided appropriately.
Right, sir.
Thank you.
Small question, sir.
Yeah.
Now, relation to the Munjal Supreme Court you are referred to regarding the partnership firm. Now, the partnership firm was carrying out the construction of some assets, and then the loan is taken for the partners. Then one has to speak about 36(1)(3), the interest to be capitalized.
Yes. When partner takes the loan and then gives to partnership firm, now partner can take loan in his own name for and on behalf of the firm. It can be accounted by the firm directly. But he accounts in his personal book, thereafter gives loan. Then he has to collect interest from the firm and then he has to pay.
That is correct. According to your very good team, that enabling provision is 36 for allowing interest to partners. The enabling provision is 36(1)(3). So when the loan partners gives loan to the firm, because of the partnership for the interest, and that money by the partnership firm is used in the capitalization of some assets, then that will be capital. That will be the issue, right? Allowed rate of interest.
No, sir. Now, with reference to 40B, it doesn't say capital. It says capital, loan, interest, whatever name you call it, interest to a partner. 40B says interest to a partner, cap is 12%.
But then enabling provision 36(1)(3), right?
Yes, 36(1)(3). So partnership firm can raise funds either from third party or from a partner.
Yeah. So I think what is the question?
Then
is the interest paid at the rate of more than 12%?
In the hands of the firm, where the interest paid to partners.
Yeah.
Whether need to be capitalized.
Yes. So we cannot claim as a capital revenue expenditure. What we want to say, it should be capitalized.
See, exactly. That's what even sir said, that the interest is to be first seen whether it is covered as per 36(1)(3) or not. That is the primary requirement. So the answer to your question, yes, it is covered under 36. It is directly not covered because it is to be capitalized. However, the interest in that case will not exceed the threshold of 12%.
That condition, that subsequent condition that needs to be followed.
Yeah.
But only when this, I think that while paying interest to the partners, this is not taken care. That's what I believe. Normally.
Yeah.
So what do the firm do? They don't pay interest?
No.
They pay interest, but they claim as a revenue expenditure. They don't capitalize.
No, as per the accounting, see, the law, even as per 36(1)(3), it has to be capitalized.
Never brought to this issue.
Okay, this goes unnoticed, so therefore our Vice President wants to bring it to the notice of the members. Very rightly, right?
Many a time, interest on partners account, automatically we call it as a revenue expense.
Automation, no?
Yeah.
Sarmaji, with your permission, only one query available here. I will just say
Sure.
that says if you do not put details of personal deduction like mediclaim, etc. in 3CD, but disclose only in ITR, whether CPC will still allow the deduction? Answer is yes. Only where there is inconsistency between tax audit report and written with reference to certain information, they will not allow. But mediclaim, payment related deductions, audit report need not certify. That will be allowed in case of an individual HUF. CPC will not deny it.
So thanks for having so much confidence on CPC. We don't have so much.
But in a given case, we have experienced. Therefore, I am confidently saying, sir, we have done it. It has come comfortably well.
Thank you, sir. Right.